Every company tells a story. Some stories talk about growth. Some talk about innovation. Some talk about profit. But behind every story, there is one deeper question. Is this company truly creating value? Investors, founders, managers, and employees make decisions every day. They hire people. They launch products. They expand into new markets. They spend money hoping the future will reward them. But hope is not value. Only disciplined thinking turns effort into value. Many people confuse activity with progress. They believe faster growth automatically means success. They believe high revenue means a strong business. They believe stock price movement reflects real performance. This book challenges those beliefs. Value is not about short-term excitement. Value is about cash flow that can be sustained. Value is about earning more than the cost of the money used. Value is about decisions that make the future stronger than the present. The world of valuation may look technical from the outside. Numbers, models, and assumptions can feel complicated. But at its heart, valuation answers simple human questions. Where should we invest? What is worth paying for? What should we stop doing? What will still matter years from now? This book teaches a way of thinking rather than just a method. It shows that value creation is not luck. It is a system built on principles, discipline, and clarity. When people understand value, they make better choices. When companies focus on value, they become resilient. When investors understand value, they stop chasing noise. Before learning formulas, we must understand foundations. Before predicting the future, we must understand what drives it. That is why the journey begins with the fundamentals. Part 1. Foundations of value. Before we measure value, we must understand where it comes from. Many people jump directly into numbers. They build models. They compare companies. They predict prices. But without clear foundations, valuation becomes guesswork. Value does not appear suddenly. It is created step by step through decisions about investment, growth, risk, and discipline. Every business is constantly answering the same question. Are we using our resources in a way that creates more value than it consumes? This part focuses on the core ideas that sit beneath every valuation model. It explains why some companies grow stronger over time, while others struggle despite high activity. It shows that value creation is less about complexity and more about clarity. The foundation begins with understanding how money moves through a business. Capital enters. The company invests. Operations generate returns. Those returns are either reinvested or distributed. When returns exceed the cost of capital, value is created. When they do not, value slowly disappears. Markets react to expectations about this process. Investors do not only look at what a company has done, they focus on what it is likely to do next. This is why understanding value requires both analysis and judgment. The chapters in this part introduce the essential building blocks. They explain the relationship between risk and return. They explore how growth can help or hurt value. They show why return on invested capital is one of the most important measures in business. They also explain how stock markets interpret performance and expectations. By the end of this part, valuation stops feeling abstract. It becomes a logical way of thinking about business decisions. You begin to see that value is not a mystery. It is the result of consistent principles applied over time. The journey begins with the most basic but powerful question. Why does value matter at all? This leads directly into the first chapter. Why value value? Chapter 1. Why value value? Every business decision carries an invisible question. Does this create value or destroy it? Companies may focus on revenue, market share, or short-term profit, but these measures alone do not explain real success. Value is the single measure that connects strategy, finance, and long-term survival. To understand why value matters, we must first understand what value means. Value represents the future benefits a business can generate for its owners. It reflects the cash a company can produce over time after covering all costs and investments. This makes value forward-looking rather than backward-looking. Profit describes what happened. Value describes what is likely to happen. Many organizations fall into the trap of activity without direction. They expand quickly, launch products, and pursue growth without asking whether these actions improve returns. Growth can feel exciting, but growth that earns less than the cost of capital quietly destroys value. This is one of the most important lessons in finance. Not all growth is good growth. Value matters because capital is limited. Money invested in one opportunity cannot be used somewhere else. Investors constantly compare alternatives. They choose businesses that promise stronger long-term returns for the risk taken. When companies understand this reality, their decisions become more disciplined. Focusing on value changes behavior. Managers begin to think about efficiency rather than size. They prioritize projects that generate durable returns. They avoid investments that look impressive but fail to produce sustainable cash flow. Value thinking encourages patience because meaningful results take time. Another reason value matters is communication. Investors, employees, and leaders need a common language. Revenue growth alone can be misleading. Cost-cutting alone can weaken the future. Value integrates growth, profitability, and risk into one framework. It helps organizations align decisions across departments and time horizons. Stock markets reflect expectations about value creation. Prices move not only because of current performance, but because expectations change. When a company shows it can earn high returns for a long period, the market rewards it. When confidence fades, prices fall even if profits remain strong in the short term. This demonstrates that value is rooted in future performance rather than present headlines. Understanding value also protects companies from short-term pressure. Leaders often face demands for immediate results. Without a value framework, they may sacrifice long-term strength for temporary gains. Value thinking provides a compass. It reminds decision-makers that sustainable cash flow and strong returns ultimately matter more than quarterly fluctuations. Value creation requires balancing three forces: return on capital, growth, risk. High returns without growth limit potential. Growth without returns destroys wealth. Low risk with weak returns leads to stagnation. Great companies manage all three simultaneously. Importantly, value is not created by finance teams alone. Operational excellence, innovation, culture, and strategy all influence value. Finance simply measures the outcome of these choices. This perspective removes the idea that valuation is purely technical. It becomes a way of thinking about how businesses work. When organizations adopt a value mindset, priorities shift. They invest with intention. They measure performance more carefully. They accept that some opportunities must be rejected. Over time, these small disciplined decisions compound into significant advantage. The purpose of this chapter is simple but powerful. To establish that value is the ultimate scorecard of business. It connects daily decisions to long-term outcomes. It explains why some companies endure, while others fade despite early success. Once we understand why value matters, the next step is learning the basic language of finance. We must see how cash flows, investments, and risk interact inside a business. That foundation leads directly into the next chapter. Chapter 2: Finance in a Nutshell. Finance is often seen as complex and technical. Many people imagine spreadsheets, formulas, and difficult terminology. But at its core, finance explains a simple idea: how money moves through a business and how that movement creates value over time. Every company follows the same basic cycle. It raises money from investors or lenders. It uses that money to build products, hire people, and operate. If the company operates well, it generates cash. That cash can be reinvested for growth or returned to owners. Finance studies this entire cycle. One of the most important distinctions in finance is the difference between profit and cash flow. Profit is an accounting measure that includes estimates and timing adjustments. Cash flow shows the actual money entering and leaving the business. A company can report strong profits while struggling with cash. This is why valuation focuses heavily on cash flow. Finance also emphasizes investment. Every business decision is an investment decision. Opening a new store, developing software, building a factory, or hiring talent all require capital. The key question is not whether growth happens. The key question is whether the return from that investment justifies the money used. Time plays a central role in finance. Money today is more valuable than money in the future because it can be invested and earn returns. This idea shapes how companies evaluate projects. Future cash flows must be translated into present value so decisions can be compared fairly. Without considering time, businesses risk overestimating opportunities. Risk is another essential element. Not all cash flows are certain. Some industries are stable, while others are volatile. Finance connects risk with expected return. Higher uncertainty requires higher expected rewards. This relationship guides investment choices across markets and companies. The cost of capital emerges from this relationship. It represents the return investors expect for providing money. This cost acts as a benchmark. If a project cannot earn more than the cost of capital, it does not create value, even if it increases revenue or profit. Understanding this idea changes how managers evaluate success. Finance also separates operating decisions from financing decisions. Operating decisions determine how the business creates products and serves customers. Financing decisions determine how the business is funded through debt and equity. Both influence value, but mixing them can create confusion. Clear analysis requires understanding each role. Another core concept is capital allocation. Companies rarely fail because of lack of ideas. They fail because capital is placed in the wrong opportunities. Finance provides tools to compare projects, prioritize investments, and avoid waste. Over time, strong capital allocation becomes a major competitive advantage. Measurement is central to finance, but numbers alone are not enough. Assumptions about growth, margins, and risk shape results. This means finance requires judgment alongside analysis. The best decision makers combine quantitative discipline with strategic thinking. Finance also creates a common language across an organization. Marketing teams talk about customer growth. Operations teams focus on efficiency. Strategy teams discuss competitive positioning. Finance connects these perspectives by translating actions into cash flow and returns. This alignment improves decision quality. Importantly, finance encourages long-term thinking. Short-term gains can look attractive but may weaken future performance. By focusing on cash flow over time, finance highlights sustainability. It rewards consistency rather than temporary spikes. At a deeper level, finance is about trade-offs: growth versus profitability, risk versus return, investment today versus flexibility tomorrow. There are rarely perfect choices. Finance helps organizations navigate these trade-offs with clarity. When people understand finance in this simple way, valuation becomes less intimidating. Valuation is not separate from finance. It is the natural extension of these ideas. It asks what a business is worth based on how it generates and grows cash flow under uncertainty. This chapter builds the basic language needed for the journey ahead. We now understand the movement of capital, the importance of cash flow, the role of time, and the relationship between risk and return. These ideas form the foundation of value creation. The next step is to explore the deeper principles that explain how companies consistently create value over long periods. This leads directly into the next chapter. Fundamental Principles of Value Creation. Chapter 3. Fundamental Principles of Value Creation. Now that we understand the basic language of finance, we can focus on the deeper principles that drive long-term value. These principles are simple, but they are powerful. When applied consistently, they explain why some companies thrive for decades, while others fade away. The first principle is clear. A company creates value only when it earns returns higher than its cost of capital. If a business invests money and earns less than investors expect for the risk taken, it destroys value even if revenue grows. This idea separates value creation from simple expansion. Return on invested capital measures how efficiently a company uses its resources. It shows how much operating profit is generated for each unit of capital invested in the business. When this return stays above the cost of capital for many years, value compounds. When it falls below, value slowly erodes. The second principle is that growth creates value only when returns remain strong. Growth by itself does not guarantee success. A company that grows quickly but earns weak returns may increase its size while reducing its economic strength. Profitable growth is what matters. This leads to an important insight. Value depends on both the level of returns and the duration of those returns. If a company can sustain high returns for a long time, its value increases significantly. Competitive advantage plays a major role here. Strong brands, cost leadership, innovation, and network effects help companies protect returns over time. The third principle involves cash flow. Accounting profits can be influenced by timing and estimates. Cash flow represents the real economic benefit that can be distributed or reinvested. Value ultimately depends on the cash a company can generate in the future. Another core principle is the relationship between risk and return. Higher risk demands higher expected returns. Companies operating in uncertain environments must deliver stronger performance to justify that uncertainty. Understanding risk prevents unrealistic expectations. Capital allocation is another powerful driver of value. Even strong businesses can destroy value if they invest in weak projects. Leaders must evaluate opportunities carefully and reject those that fail to meet required returns. Disciplined capital allocation separates great management teams from average ones. Cost control is important, but cutting costs without strategy can weaken the future. Value creation requires balance. Investing in research, talent, and customer experience may reduce short-term profits, but strengthen long-term cash flow. The key is ensuring these investments earn adequate returns. The principle of long-term perspective cannot be ignored. Markets often react to short-term news. However, sustainable value depends on long-term performance. Companies that sacrifice future strength for immediate results often regret those decisions. Patience and discipline are essential. Transparency also supports value creation. Clear communication builds trust with investors and employees. When expectations are realistic and performance is measured honestly, confidence grows. This reduces uncertainty and supports stable valuation. Another fundamental idea is consistency. One strong year does not create lasting value. Value grows when companies repeatedly earn strong returns while managing risk. Consistency builds reputation, and reputation attracts capital at reasonable cost. Innovation plays a role as well. New products and services create opportunities for growth. However, innovation must align with the company's capabilities and strategy. Random expansion rarely leads to sustainable advantage. Scale can enhance value when it improves efficiency or strengthens competitive position. But size alone is not the goal. Efficient scale with strong margins creates value. Inefficient expansion creates complexity without benefit. These principles work together rather than independently. High returns support growth. Strong competitive advantage protects returns. Disciplined capital allocation maintains efficiency. Clear communication supports investor confidence. Together, they form a system of value creation. Understanding these principles changes how we view business success. Instead of asking how fast a company is growing, we ask how profitably it is growing. Instead of celebrating revenue milestones alone, we examine returns on capital. Instead of chasing trends, we focus on durable economic advantage. This chapter establishes that value creation is not mysterious. It follows logical economic rules. Companies that respect these rules build strength over time. Companies that ignore them often struggle despite high activity. With these principles in place, the next step is to explore how risk influences value and how investors determine the cost of capital. Understanding this connection deepens our view of value creation. This leads directly into the next chapter. Chapter 4. Risk and the cost of capital. Every investment involves uncertainty. Companies plan for the future, but the future is never guaranteed. Customer demand can change. Technology can shift. Competition can increase. Economic conditions can weaken. Because of this uncertainty, risk becomes central to valuation. Risk represents the possibility that actual results differ from expectations. Some businesses operate in stable environments with predictable cash flow. Others face rapid change and higher volatility. Investors recognize these differences and adjust their expectations accordingly. This leads to one of the most important ideas in finance. Higher risk requires higher expected return. Investors provide capital with the understanding that uncertainty deserves compensation. If two opportunities promise the same return, rational investors choose the less risky one. The cost of capital emerges from this relationship between risk and return. It represents the minimum return investors expect for providing money to a company. This cost becomes a benchmark for decision-making. Projects that earn more than the cost of capital create value. Projects that earn less reduce value even if they increase revenue or scale. Cost of capital includes both equity and debt. Equity investors accept more uncertainty and therefore expect higher returns. Debt providers receive fixed payments and usually accept lower returns because risk is lower. The combined expectation forms the overall cost of capital for the business. Understanding this concept changes how companies evaluate growth. Growth funded by cheap capital may look attractive, but if the underlying business is risky, the true cost is higher. Ignoring risk can lead to overinvestment and disappointing outcomes. Risk itself has different dimensions. Business risk reflects the stability of operations and industry dynamics. Financial risk relates to the amount of debt used. More debt can increase returns during strong periods, but also magnifies losses during downturns. Balancing these risks is essential. Another important distinction is between diversifiable and non-diversifiable risk. Some risks affect individual companies and can be reduced through diversification. Other risks affect the entire market and cannot be avoided. Investors mainly demand compensation for the risks they cannot eliminate. Market expectations play a role in determining the cost of capital. Interest rates, economic outlook, and investor sentiment influence required returns. This means the cost of capital is not fixed. It changes as conditions change. Companies must update assumptions regularly. Estimating the cost of capital requires judgment. Historical data provides guidance, but the future may differ. Assumptions about growth, inflation, and industry dynamics shape the estimate. Small changes can significantly influence valuation results. This is why transparency about assumptions is important. The cost of capital also influences strategic decisions beyond valuation. It affects pricing, expansion plans, acquisitions, and capital structure choices. Companies that understand their cost of capital allocate resources more effectively. They avoid projects that appear attractive, but fail to meet required returns. Risk management becomes a critical capability. Companies cannot eliminate uncertainty, but they can prepare for it. Diversified revenue streams, strong balance sheets, flexible operations, and clear strategy reduce vulnerability. Lower risk can reduce the cost of capital and increase value. Communication with investors also shapes perceived risk. When companies provide clear guidance and consistent performance, uncertainty declines. Trust reduces the risk premium investors demand. This demonstrates that risk is influenced not only by operations, but also by credibility. Importantly, taking risk is not negative. Value creation often requires accepting uncertainty. Innovation, expansion, and transformation involve risk. The goal is not to avoid risk, but to take informed risk where expected returns justify it. This perspective reframes decision-making. Instead of asking whether a project is risky, leaders ask whether the expected reward compensates for that risk. This mindset encourages disciplined but bold action. Understanding risk and the cost of capital completes a major piece of the value creation puzzle. We now see that value depends not only on how much cash a company generates, but also on how uncertain that cash is. Two companies with similar cash flow can have very different values because their risks differ. With this foundation, the next step is to explore how stock market performance reflects these forces of growth, returns, and expectations. This leads directly into the next chapter, the alchemy of stock market performance. Chapter 5. The Alchemy of Stock Market Performance. Stock market performance often appears mysterious. Prices rise and fall daily. News headlines suggest sudden changes in value. Many people assume markets move randomly or are driven purely by emotion. But beneath short-term noise, stock performance follows clear economic forces. At its core, stock market performance reflects expectations about future value creation. Investors buy shares based on what they believe a company will achieve over time. When expectations improve, prices rise. When confidence weakens, prices fall. This means stock returns depend not only on actual results, but also on changes in expectations. Three primary drivers shape long-term stock performance: return on invested capital, growth, valuation expectations. These forces interact continuously. Understanding their relationship removes much of the mystery around market behavior. Return on invested capital represents business quality. Companies that consistently earn strong returns demonstrate competitive advantage. Markets reward this reliability because it suggests durable cash flow. Sustained high returns often lead to premium valuation. Growth represents the expansion of opportunity. When a company can reinvest at attractive returns, growth becomes a powerful engine of value. However, growth that lacks profitability does not support stock performance over the long term. Markets eventually recognize the difference between expansion and value creation. The third driver is expectations embedded in the stock price. Every stock already reflects a set of assumptions about the future. If a company performs better than those expectations, the stock may rise. If results fall short, the stock may decline, even when performance appears strong in absolute terms. This explains why good companies sometimes experience weak stock returns. Stock performance, therefore, depends on the gap between expectations and reality. Surprises matter more than raw numbers. This insight shifts the focus from predicting outcomes to understanding what the market already believes. Market psychology influences short-term movements. Fear, excitement, and momentum can push prices away from fundamentals temporarily. However, these effects rarely persist indefinitely. Over longer periods, cash flow and returns dominate. Fundamentals act as gravity pulling prices toward economic value. Another important concept is multiple expansion and contraction. Valuation multiples reflect investor confidence about future performance. When confidence increases, investors may pay more for each unit of earnings or cash flow. When uncertainty rises, multiples decline. These shifts can significantly influence stock returns even if business performance remains stable. Economic cycles also affect stock performance. During strong periods, growth expectations rise and risk perception declines. During downturns, caution increases and valuations compress. Understanding cycles helps explain market behavior without assuming irrationality. Long-term investors benefit from focusing on drivers rather than daily price movement. By analyzing returns on capital, reinvestment opportunities, and competitive advantage, they gain insight into future value creation. This perspective reduces the temptation to react to short-term volatility. Stock market performance also reflects capital allocation decisions. Acquisitions, divestitures, dividends, and share repurchases influence how value is distributed. Well-executed capital allocation supports strong returns. Poor decisions can reduce investor confidence even when operations remain healthy. Communication plays a role as well. When companies clearly explain strategy and performance, expectations become more aligned with reality. This reduces surprise and supports stable valuation. Unclear communication increases uncertainty and volatility. Importantly, stock market performance is not a perfect measure of managerial success in the short term. External factors can influence prices temporarily. However, over longer periods, companies that create value tend to see their stock performance reflect that achievement. This chapter highlights that market behavior is not random chaos. It is the result of expectations interacting with economic fundamentals. Return on capital, growth, and changes in perception form the engine behind stock performance. Understanding this dynamic helps investors avoid common mistakes. Chasing recent winners without understanding expectations can lead to disappointment. Ignoring strong businesses during temporary pessimism can mean missed opportunities. Clarity about drivers improves decision-making. With this insight, we can now explore how new areas such as environmental initiatives and digital transformation influence valuation and value creation. Modern businesses operate in changing environments, and valuation must adapt. This leads directly into the next chapter. Valuation of ESG and digital initiatives. Chapter 6. Valuation of ESG and digital initiatives. Business environments are changing rapidly. Companies are investing more in environmental responsibility, social impact, governance practices, and digital transformation. These initiatives often promise long-term benefits, but may not produce immediate profit. This creates a challenge for valuation. How should investments with uncertain and delayed outcomes be measured? The key principle remains the same. Any initiative creates value when it improves future cash flow or reduces risk. ESG and digital projects should not be evaluated based on popularity or pressure alone. They must be analyzed through their economic impact on the business. Environmental initiatives can influence value in multiple ways. They may reduce operating costs through efficiency. They can lower regulatory risk. They may strengthen brand reputation and customer loyalty. In some industries, they protect long-term viability by aligning with changing policies and consumer preferences. These effects ultimately shape cash flow and risk, which drive valuation. Social initiatives also contribute to value creation. Investments in employee well-being, diversity, and community relationships can improve productivity and retention. Stronger culture reduces turnover costs and supports innovation. Although these benefits may be difficult to measure precisely, they influence long-term performance. Governance plays a critical role in investor confidence. Transparent reporting, ethical leadership, and effective oversight reduce uncertainty. Lower uncertainty can reduce the cost of capital. This means governance improvements can increase value even without immediate revenue growth. Digital transformation represents another major shift. Technology investments can improve efficiency, scalability, and customer experience. Digital platforms often enable faster growth with lower marginal cost. However, digital initiatives require significant upfront investment and carry execution risk. Valuation must balance potential upside with uncertainty. One common mistake is treating ESG and digital projects as separate from core strategy. When these initiatives align with competitive advantage, they strengthen value creation. When they exist only for appearance, they consume resources without clear return. Integration with business economics is essential. Measuring these initiatives requires focusing on drivers rather than labels. How will costs change? How will revenue opportunities expand? How will risk exposure shift? How long will the benefits last? These questions translate broad concepts into financial impact. Time horizon becomes especially important. Many ESG and digital investments produce benefits gradually. Short-term performance may decline, while long-term potential improves. Organizations must communicate this clearly to investors to maintain alignment of expectations. Another challenge is uncertainty. Technology evolves quickly. Regulations change. Consumer preferences shift. Because of this, scenario analysis becomes useful. Instead of relying on one forecast, companies evaluate multiple possible outcomes. This approach improves decision quality. Digital initiatives often change business models rather than simply improving operations. Subscription services, platform ecosystems, and data-driven strategies create new revenue streams. Valuation must consider how these models influence growth, margins, and capital needs. Traditional metrics may require adjustment. ESG initiatives can also affect access to capital. Investors increasingly consider sustainability when allocating funds. Companies perceived as responsible may attract capital at lower cost. This directly influences valuation through the cost of capital. Importantly, not every ESG or digital investment creates value. Projects must be prioritized based on expected impact. Discipline remains essential. The goal is not to do everything, but to do the right things well. Leadership plays a major role in successful implementation. Clear strategy, measurable goals, and accountability ensure initiatives translate into performance. Without execution, potential value remains theoretical. This chapter reinforces a broader lesson. Valuation evolves with the business environment, but the underlying logic remains constant. Cash flow, growth, and risk continue to determine value regardless of the initiative type. New trends must be translated into these fundamental drivers. Understanding how ESG and digital initiatives influence value prepares us to examine a related idea. Markets constantly interpret new information and incorporate it into prices. This leads to an important question about market intelligence and efficiency. That question guides the next chapter. The stock market is smarter than you think. Chapter 7. The stock market is smarter than you think. Many investors believe they can easily outsmart the market. They search for hidden information, short-term signals, or trends that others have missed. Sometimes this works temporarily, but over long periods, markets tend to reflect available information surprisingly well. This idea does not mean markets are perfect, but it does mean they are highly competitive. The stock market represents the combined judgment of millions of participants. Professional investors, analysts, institutions, and individuals constantly evaluate companies. New information spreads quickly. Prices adjust as expectations change. Because of this collective intelligence, consistently beating the market is difficult. One important insight is that current stock prices already include widely known information. Strong earnings, popular products, and industry growth are rarely secrets. When investors buy a stock simply because a company looks strong, they may be paying for expectations that are already reflected in the price. Value lies not in obvious quality alone, but in differences between expectations and future reality. This perspective changes how valuation should be approached. Instead of asking whether a company is good, the question becomes what the market already believes about that company. If expectations are extremely high, even strong performance may disappoint. If expectations are low, modest improvement can create significant stock returns. Markets are efficient in processing information, but they are not perfectly rational at every moment. Emotions, narratives, and momentum can influence prices in the short term. However, these deviations often correct over time as fundamentals reassert themselves. This balance explains why opportunities exist but are difficult to find. Another implication is the importance of humility. Assuming the market is wrong without strong evidence can lead to costly mistakes. Successful investors respect market intelligence while searching for areas where understanding may be incomplete. Patience becomes essential because mispricing may take time to correct. Competition among investors drives efficiency. Advanced technology, data analysis, and research capabilities have improved dramatically. Information that once created advantage is now widely available. This means edge increasingly comes from perspective, discipline, and long-term thinking rather than secret data. Expectations embedded in prices can be analyzed. By examining valuation levels, growth assumptions, and return expectations, investors can infer what the market anticipates. This process helps identify situations where expectations appear too optimistic or too pessimistic. Valuation becomes a tool for understanding market belief rather than predicting exact outcomes. Market efficiency also highlights the importance of process. Short-term predictions are uncertain. A consistent framework based on value creation principles improves decision quality. Instead of reacting to noise, disciplined investors focus on drivers that matter over time. The idea that the market is smart does not remove the possibility of outperformance. It simply raises the standard required to achieve it. Insight must be deeper, time horizon longer, and behavior more patient than average. Emotional reactions often create more mistakes than lack of information. Corporate leaders can also learn from this perspective. Stock prices reflect expectations about strategy and execution. When companies communicate clearly and deliver consistently, expectations become more accurate. This reduces volatility and supports stable valuation. Misunderstanding market intelligence can lead to frustration. Companies may deliver strong results, yet see limited stock movement because expectations were already high. Conversely, struggling companies may experience rallies when performance improves relative to low expectations. Recognizing this dynamic prevents misinterpretation of market signals. Over long periods, markets tend to reward value creation. Companies that sustain high returns and disciplined growth usually see stock performance reflect that success. Short-term fluctuations may obscure this relationship, but the connection remains strong over time. This chapter reinforces an important mindset. Valuation is not about proving the market wrong. It is about understanding what the market believes and assessing whether those beliefs are reasonable. Respecting market intelligence encourages thoughtful analysis rather than overconfidence. With this perspective, we are ready to examine one of the most powerful measures of business quality. Return on invested capital explains how efficiently companies turn resources into profit. Understanding this metric deepens our view of value creation. This leads directly into the next chapter. Return on invested capital. Chapter 8. Return on invested capital. Return on invested capital is one of the most important measures in business. It answers a simple but powerful question. How effectively does a company use the money entrusted to it? This metric connects operations, strategy, and finance into a single view of performance. Invested capital represents the resources required to run the business. It includes money spent on buildings, equipment, technology, inventory, and other operating assets. When a company generates operating profit from these resources, it produces a return. Comparing profit with invested capital reveals efficiency. A high return on invested capital indicates that a company can generate strong profit without needing excessive resources. This often signals competitive advantage. Strong brands, efficient processes, network effects, or proprietary technology allow companies to earn more from each unit of capital. Sustained high returns are rare and valuable. The relationship between return on invested capital and the cost of capital determines value creation. If returns exceed the cost of capital, the company creates value. If returns fall below, the company destroys value even if it continues to grow. This comparison provides clarity that revenue growth alone cannot offer. Return on invested capital also reveals the quality of growth. Two companies may grow at similar rates, but the one earning higher returns creates more value. Growth supported by strong returns compounds wealth. Growth with weak returns consumes resources without adequate reward. Understanding the drivers of return on invested capital helps managers improve performance. Profit margins influence how much earnings are generated from each sale. Capital efficiency influences how much investment is required to support operations. Improving either driver increases returns. Improving both creates powerful results. Operational decisions directly affect this metric. Pricing strategy, cost management, supply chain design, and product mix shape margins. Inventory management, asset utilization, and working capital policies shape capital intensity. Return on invested capital reflects the outcome of countless daily decisions. Competitive advantage plays a central role in sustaining strong returns. Without differentiation, competition pushes returns toward average levels. Companies must continually strengthen their position through innovation, customer relationships, and operational excellence. Sustaining returns is often more challenging than achieving them initially. Industry structure also influences return levels. Some industries naturally require heavy investment, which limits returns. Others allow scalable growth with limited capital, enabling higher returns. Understanding industry economics helps set realistic expectations. Measurement requires careful adjustment. Accounting figures may include items that do not reflect core operations. Separating operating performance from financing effects improves accuracy. Clear measurement ensures decisions are based on true economics rather than accounting noise. Return on invested capital also guides capital allocation. Projects expected to earn strong returns deserve priority. Projects with weak expected returns should be reconsidered or redesigned. This discipline prevents resources from being spread too thin. Long-term performance depends not only on current returns, but also on the ability to reinvest at similar levels. Companies with many attractive reinvestment opportunities create significant value over time. Companies with limited opportunities may generate strong returns but struggle to grow. Balancing return and reinvestment is essential. Investors closely monitor this metric because it reveals business quality more clearly than many traditional measures. Consistent high returns signal durable advantage and efficient management. Declining returns may indicate rising competition, operational challenges, or strategic misalignment. Communication around return on invested capital improves organizational alignment. When teams understand how their actions influence this metric, decision-making becomes more value-focused. It shifts attention from activity toward efficiency and impact. Importantly, maximizing return in the short term should not come at the expense of future opportunity. Reducing investment can temporarily raise returns, but weaken long-term growth. Sustainable value creation requires balancing efficiency with strategic investment. Return on invested capital connects directly to the broader value creation framework introduced earlier. High returns, sustained over time, and supported by disciplined reinvestment form the engine of value. This metric transforms abstract strategy into measurable economic performance. With a clear understanding of return on invested capital, the next step is to examine the role of growth more deeply. Growth interacts with returns to shape value outcomes. Understanding this relationship completes the foundation of value creation. This leads directly into the next chapter. Growth. Chapter 9. Growth. Growth is one of the most celebrated ideas in business. Companies announce expansion plans. Investors search for fast-growing firms. Media highlights rising revenue as a sign of success. Yet growth alone does not guarantee value creation. Understanding the quality of growth is essential. Growth creates value only when it is supported by strong returns on invested capital. If a company reinvests money at returns higher than its cost of capital, each new investment increases value. This process allows value to compound over time. When returns are weak, growth consumes resources and reduces economic strength. This distinction explains why some rapidly expanding companies struggle financially. Revenue may rise while cash flow remains limited. Large investments may be required to sustain growth. Without adequate returns, expansion becomes expensive rather than beneficial. Sustainable growth depends on reinvestment opportunities. Companies must find projects, markets, or innovations that can absorb capital while maintaining attractive returns. Businesses with many such opportunities have significant long-term potential. Businesses with limited opportunities may generate strong returns, but face slower expansion. The sources of growth vary across industries. New customers increase volume. Pricing improvements increase revenue per customer. New products open additional markets. Operational efficiency can also support growth by freeing resources for reinvestment. Understanding these sources helps evaluate whether growth is durable. Competitive advantage plays a central role. Without differentiation, competitors quickly erode returns as growth attracts attention. Strong brands, technology leadership, network effects, or cost advantages protect profitable expansion. Growth supported by advantage tends to last longer. Time horizon matters when evaluating growth. Short-term acceleration can result from temporary factors such as promotions or favorable market conditions. Long-term growth requires structural drivers such as innovation, demographic trends, or industry transformation. Distinguishing between temporary and structural growth improves valuation accuracy. Growth also influences risk. Rapid expansion often requires new investments, operational complexity, and strategic uncertainty. While potential rewards increase, so does variability. Valuation must consider both opportunity and uncertainty. Another important idea is the relationship between growth and free cash flow. High-growth companies may generate limited free cash flow because resources are reinvested. This does not necessarily indicate weakness if reinvestment earns strong returns. However, persistent low cash generation without clear return potential raises concerns. companies eventually transition through stages of growth. Early stages focus on expansion and market entry. Later stages emphasize efficiency and cash generation. Valuation must reflect where a company sits within this life cycle. Expectations that ignore life cycle dynamics often lead to mispricing. Management discipline shapes growth quality. Clear strategy prevents expansion into areas without competitive strength. Prioritization ensures capital flows toward the most attractive opportunities. Restraint can be as valuable as ambition. Investors benefit from focusing on the interaction between growth and returns rather than growth alone. A slower growing company with very high returns may create more value than a fast-growing company with weak economics. This perspective reduces the tendency to chase excitement. Communication about growth expectations is equally important. Overly optimistic forecasts can damage credibility if not achieved. Realistic guidance builds trust and supports stable valuation. Transparency allows markets to align expectations with strategy. Growth also shapes valuation through its duration. A company able to sustain above-average growth for a longer period typically commands higher value. Duration reflects competitive strength, innovation capacity, and market opportunity. Estimating duration requires judgment and continuous reassessment. This chapter completes the core foundation of value creation. We now understand that value emerges from the interaction of returns, growth, and risk. High returns create economic strength. Growth amplifies that strength when reinvestment opportunities exist. Risk influences how future benefits are valued. With these principles established, the next step is learning how to apply them in practice. Valuation moves from concept to method. Financial statements must be reorganized. Performance must be analyzed. Future cash flows must be forecasted. These practical tools formed the focus of the next part: core valuation techniques. Imagine you are standing in front of a powerful machine. This machine represents a real company. It has employees, factories, software, customers, debts, and dreams. It produces products, generates revenue, and spends money. Now someone asks you a simple but serious question. What is this entire machine truly worth today? Not what the headlines say, not what the market feels this morning, but what is the business fundamentally worth based on the cash it can generate in the future? This is where valuation moves from philosophy to precision. In the first part, we explored why value matters and what creates it. We learned that value comes from earning returns higher than the cost of capital. We understood that growth only creates value under the right conditions. We saw that markets reflect expectations about future performance. Now the question becomes practical. How do we actually measure all of this? Many people think valuation is guessing. Others think it is complex mathematics that only experts understand. In reality, valuation is structured thinking. It is about organizing information, asking the right questions, and connecting performance to future cash flow. Valuation begins by looking clearly at the business. Financial statements must be reorganized to separate operating activities from financing choices. Performance must be analyzed to understand margins, capital efficiency, and growth patterns. History gives us clues, but it does not give us answers. Then comes forecasting. We estimate how revenue might grow. We consider how costs may change. We think about how much capital the company must invest to support growth. Every assumption must be realistic and internally consistent. But even after forecasting several years, the story is not finished. Most of a company's value often comes from the years far into the future. This is why estimating continuing value becomes so important. It forces us to think about sustainability, competition, and long-term stability. At the same time, we must measure risk carefully. The cost of capital reflects the return investors expect for taking risk. If we underestimate risk, we overestimate value. If we overestimate risk, we undervalue strong businesses. Once enterprise value is calculated, we move toward equity value and finally value per share. But the process does not end with a single number. Good valuation requires analyzing the results. We test different assumptions. We ask what truly drives the outcome. We compare our findings with market prices and multiples. Multiples provide quick perspective. Valuation by parts helps when companies operate in different businesses. Each technique supports the main framework. None replaces disciplined thinking. This part of the book provides the tools. It turns principles into practice. It shows that valuation is not magic. It is a logical sequence of steps built on economic reality. Before we calculate anything, however, we need a clear structure. We need a framework that connects business performance to value in a consistent way. That is where this section begins. The journey into practical valuation starts with one essential question. What framework should we use to value a company correctly? This leads directly into the first chapter of this part. Frameworks for Valuation. Chapter 10. Frameworks for Valuation. Imagine two investors looking at the same company. Both read the annual report. Both see the same revenue, the same profit, the same growth rate. Yet one believes the company is expensive and the other believes it is a great opportunity. Why does this happen? The difference is not only opinion. The difference is framework. A framework is a structured way of thinking. It is a map that guides how we move from information to conclusion. Without a framework, valuation becomes scattered. With a framework, valuation becomes disciplined and repeatable. At its heart, valuation answers one question. How much future cash will this business generate, and what is that cash worth today? Everything else supports this central idea. There are many ways people attempt to value companies. Some rely only on accounting profit, some focus only on earnings per share. Some compare price multiples without deeper analysis. These shortcuts may feel convenient, but they can mislead. The most reliable framework begins with cash flow. A company creates value by generating cash that can be distributed to investors or reinvested at attractive returns. Accounting profit can be influenced by non-cash items, policies, and timing differences. Cash flow is harder to manipulate and closer to economic reality. The core framework used in modern finance is discounted cash flow. The logic is simple. Money received in the future is worth less than money received today. Therefore, future cash must be adjusted to reflect time and risk. When we estimate all expected future cash flows and bring them back to today using the cost of capital, we arrive at enterprise value. This framework forces clarity. It requires explicit assumptions about growth, margins, investment, and risk. It makes the driver of value visible. It connects strategy directly to financial outcome. However, discounted cash flow is not just a formula. It is a way of organizing thinking. It requires understanding the economics of the business. What drives revenue growth? What determines operating margins? How much capital is needed to support expansion? How sustainable are returns on invested capital? A strong framework separates operating decisions from financing decisions. Operating performance determines how efficiently the company creates value. Financing decisions determine how that value is distributed between debt holders and equity holders. Mixing the two can create confusion. This is why enterprise value is calculated first. Enterprise value reflects the value of operations independent of capital structure. Only after determining enterprise value do we adjust for debt and other claims to arrive at equity value. Another important element of the framework is consistency. Assumptions about growth must align with assumptions about investment. If revenue grows rapidly, additional capital is usually required. Ignoring this link overstates value. A good framework keeps growth, returns, and reinvestment logically connected. The framework also emphasizes long-term thinking. Short-term fluctuations may influence reported earnings, but intrinsic value depends on long-term sustainable performance. Temporary improvements do not create lasting value unless they change future cash flow permanently. Multiples such as price to earnings or enterprise value to earnings before interest and taxes are often used as quick references. Within a disciplined framework, multiples are not independent tools. They are simplified expressions of discounted cash flow. Behind every multiple lies an assumption about growth, risk, and return on capital. Understanding this connection prevents mechanical comparisons. For example, two companies may have identical earnings, but if one has higher return on invested capital and better growth prospects, its justified multiple should be higher. Without a framework, investors may treat both companies as equal. With a framework, differences become visible. Another key feature of valuation frameworks is scenario analysis. The future is uncertain. No forecast will be perfect. Instead of searching for precision, a good framework examines ranges of outcomes. What happens if growth slows? What happens if margins improve? What happens if the cost of capital changes? This approach builds resilience into decision-making. Valuation frameworks also discipline emotion. Markets can become optimistic or fearful. Prices can move quickly. But a structured model anchors judgment in economics rather than mood. It does not guarantee correct predictions, but it reduces impulsive decisions. There are alternative frameworks that complement discounted cash flow. Economic profit models measure value creation by calculating profit after charging for the cost of capital. Adjusted present value separates operating value from financing side effects. Real options analysis considers managerial flexibility in uncertain environments. Each of these methods shares a common foundation. They all connect value to future cash generation and risk. The choice of framework depends on purpose. For mergers and acquisitions, detailed discounted cash flow analysis may be required. For quick market comparisons, multiples may provide insight. For capital allocation within a company, economic profit measures may be most helpful. What matters is consistency and economic logic. A framework is powerful because it creates transparency. When assumptions are visible, they can be challenged and improved. When logic is explicit, errors become easier to detect. Without structure, hidden assumptions distort conclusions. Perhaps the most important lesson of this chapter is that valuation is not about complexity. It is about coherence. A simple, internally consistent model is better than a complicated one filled with contradictions. Clarity creates credibility. At the center of every sound framework lies a simple principle. Value equals the present value of future cash flows generated by operations. Those cash flows depend on growth, return on invested capital, and competitive advantage. Risk determines the rate at which we discount those cash flows. Everything connects. Strategy influences growth. Operations influence margins. Capital efficiency influences reinvestment needs. Risk influences investor expectations. The framework ties these elements together into one integrated view. When investors and managers adopt a disciplined valuation framework, conversations change. Debates shift from opinion to drivers. Instead of asking whether a stock feels expensive, they ask what assumptions justify the current price. Instead of celebrating revenue growth alone, they examine whether growth creates value. Frameworks do not remove uncertainty, but they provide structure within uncertainty. They transform valuation from speculation into analysis. As we move forward, this framework will guide every step. We will reorganize financial statements to reflect economic reality. We will analyze historical performance to understand value drivers. We will forecast future performance with disciplined assumptions. We will estimate continuing value and cost of capital with care. This chapter establishes the map. The next chapters will walk the path in detail. Valuation begins not with numbers, but with a clear and consistent framework for thinking about value. Chapter 11, Reorganizing the Financial Statements. Before we can value a company correctly, we must see it clearly. Financial statements are the starting point. They contain income statements, balance sheets, and cash flow statements. But in their reported form, they are designed for accounting compliance, not valuation clarity. Accounting follows rules. Valuation follows economic logic. The two are related, but they are not identical. If we use financial statements exactly as reported, we may mix operating performance with financing choices. That can distort our understanding of value creation. The first task in valuation is to reorganize the financial statements. This does not mean changing the facts. It means rearranging information so that the economic story becomes visible. The most important distinction is between operating activities and financing activities. Operating activities include producing goods, delivering services, managing costs, and investing in assets that generate revenue. Financing activities include borrowing money, issuing shares, and paying interest or dividends. Why is this separation important? Because operating performance shows how well the business creates value. Financing decisions show how that value is distributed and funded. If we mix them together, we cannot measure return on invested capital accurately. Start with the income statement. We focus on operating profit after tax. Interest expense is removed from operating analysis because it relates to financing, not operations. This allows us to measure performance independent of capital structure. Next comes the balance sheet. We separate operating assets from non-operating assets. Operating assets include working capital, property, equipment, and intangible assets used in the business. Non-operating assets may include excess cash or investments not required for core operations. On the liabilities side, we separate operating liabilities from debt and other financing obligations. Operating liabilities such as accounts, payable support daily business activity. Debt represents financing choice. Once this reorganization is complete, we can calculate invested capital. Invested capital represents the total funds invested in operations. It includes equity and debt used to finance operating assets. This figure becomes central to measuring return on invested capital. The cash flow statement must also be aligned with operating logic. We focus on free cash flow. Free cash flow represents the cash generated by operations after necessary investments to sustain growth. It is the cash available to all providers of capital. Reorganizing statements also requires adjustments. Some accounting items may distort economic reality. For example, one-time gains or losses should be removed to reflect sustainable performance. Provisions and reserves may need review to ensure they represent true economic obligations. Consistency is essential. All calculations must align with each other. Operating profit must relate to operating invested capital. Free cash flow must reflect changes in operating assets and liabilities. This process may appear technical, but its purpose is simple. We are trying to see how efficiently the company turns invested capital into operating profit and cash flow. Without reorganization, that relationship remains hidden. Clear structure leads to better insight. When statements are reorganized properly, patterns emerge. We can observe whether margins are stable. We can see whether capital intensity is rising. We can identify whether growth requires heavy reinvestment. Reorganization also improves comparability. Different companies may use different financing structures. By focusing on operating performance first, we can compare businesses more fairly. This step builds the foundation for everything that follows. If the financial base is unclear, forecasts will be weak. If invested capital is miscalculated, return metrics will mislead. If free cash flow is distorted, valuation results will be unreliable. Valuation is only as strong as its inputs. Reorganizing financial statements ensures that those inputs reflect economic truth rather than accounting form. With clear and consistent financial statements, we are ready for the next step. We can now analyze how the company has performed historically. Understanding past performance helps us forecast future performance. This leads directly into the next chapter. Analyzing performance. Chapter 12. Analyzing performance. Once financial statements are reorganized to reflect economic reality, the next step is understanding what they reveal. Numbers alone do not create insight. Insight comes from interpreting relationships between growth, profitability, and capital efficiency. Performance analysis answers a simple question. How effectively has this company created value in the past? The most important starting point is return on invested capital. This measure connects operating profit to the capital required to generate it. It shows how efficiently management uses resources. If return on invested capital consistently exceeds the cost of capital, the company is creating value. If it does not, growth may actually reduce value instead of increasing it. Return on invested capital can be broken into two main components: operating margin and capital turnover. Operating margin measures how much operating profit is generated from each unit of revenue. Capital turnover measures how much revenue is generated from each unit of invested capital. Together, they explain why return on invested capital is high or low. A company may have strong margins, but require heavy investment in assets. Another may operate with thin margins, but extremely efficient use of capital. Understanding this balance reveals the economic character of the business. Growth is the next major element of performance analysis. Revenue growth attracts attention, but it must be evaluated carefully. Growth consumes capital. If a company expands quickly but earns low returns on new investments, overall value can decline. High growth is valuable only when returns on new capital exceed the cost of capital. Analyzing historical growth helps identify patterns. Is growth stable or volatile? Does it come from price increases, volume expansion, or acquisitions? Each source carries different implications for sustainability. Margins also require deeper examination. Are improvements driven by operational efficiency or temporary cost reductions? Are margins higher than competitors because of competitive advantage or short-term conditions? Comparing performance over multiple years reduces the risk of drawing conclusions from unusual periods. Capital efficiency trends are equally important. Has the company become more efficient in using working capital? Has asset turnover improved? Has management invested wisely or accumulated underperforming assets? These questions reveal discipline in capital allocation. Another useful perspective is economic profit. Economic profit measures the amount of profit remaining after charging for the cost of capital. It highlights whether reported accounting profit truly represents value creation. Positive and growing economic profit signals strengthening competitive position. Performance analysis must also consider industry dynamics. Some industries naturally earn higher returns because of barriers to entry or strong differentiation. Others face intense competition that limits profitability. A company's performance should be viewed relative to its industry environment. Volatility is another dimension. Stable earnings and steady returns often signal durable business models. Highly volatile results may indicate exposure to economic cycles or unstable demand. Understanding volatility helps assess risk and sustainability. It is also important to identify one-time items or unusual events. Restructuring charges, asset sales, or extraordinary gains can distort trends. Removing these effects creates a clearer picture of recurring performance. Cash flow trends deserve special attention. A company may report strong earnings but weak cash generation. If working capital expands rapidly or capital expenditures remain high, free cash flow may lag behind profit. Sustainable value creation ultimately depends on cash. Performance analysis is not about predicting the future directly. It is about understanding the economic engine of the business. It reveals strengths that may persist and weaknesses that may require change. This process also builds credibility in forecasting. When analysts understand historical drivers, they can project future performance more realistically. Assumptions become grounded in evidence rather than optimism. Patterns often emerge during careful analysis. A company with steadily improving return on invested capital may possess strong management discipline. A company with declining margins may face rising competition or cost pressure. Recognizing these signals early strengthens valuation judgment. Performance must also be evaluated over an appropriate time horizon. Short periods can be misleading. Economic cycles, commodity prices, or temporary disruptions may distort results. Looking across several years provides perspective. Ultimately, analyzing performance connects numbers to strategy. High returns may reflect brand strength, cost leadership, innovation, or network effects. Weak returns may reflect poor positioning or inefficient operations. Understanding these links deepens confidence in valuation conclusions. This chapter emphasizes that valuation is not mechanical. It requires interpretation and thoughtful questioning. Performance analysis transforms reorganized financial statements into meaningful insight. By understanding how the company has created or destroyed value in the past, we prepare for the next step. We move from looking backward to looking forward. We begin forecasting performance. Chapter 13. Forecasting Performance. After understanding how a company has performed in the past, the next step is looking ahead. Valuation depends on the future, not the past. Historical analysis builds foundation, but forecasting builds value. Forecasting is not about predicting the future perfectly. It is about forming disciplined expectations based on economic logic. Good forecasts are consistent, transparent, and connected to real business drivers. The first element of forecasting is revenue growth. Growth assumptions must reflect industry conditions, competitive position, and market opportunity. A company operating in a mature industry cannot grow rapidly forever. A company with strong competitive advantage may sustain higher growth for longer. The key is realism. Growth should also be broken into components. Volume growth reflects demand expansion. Price growth reflects pricing power and inflation. Acquisition growth reflects strategic expansion. Each source of growth has different implications for risk and sustainability. Next comes operating margin. Forecasting margin requires understanding cost structure. Are costs mostly fixed or variable? Will scale improve efficiency? Is competition likely to reduce pricing power? Margins cannot expand indefinitely without reason. Operating margin and revenue growth together determine operating profit. But profit alone is not enough. We must also forecast reinvestment needs. Reinvestment includes capital expenditures and working capital. If revenue grows, the company usually needs more assets. New factories, new technology, and larger inventories require funding. Ignoring reinvestment leads to overstated free cash flow. The link between growth and investment is critical. High growth often requires high reinvestment. If reinvestment earns strong returns, value increases. If returns decline, rapid growth can weaken performance. Return on invested capital becomes central in forecasting. We must estimate whether future returns will remain stable, improve, or decline. Competitive advantage determines this path. Strong brands, patents, or network effects may protect high returns. Intense competition may push returns downward over time. Forecasts should also reflect industry cycles. Some industries move with economic conditions. During expansion, margins and growth may rise. During recession, both may fall. A balanced forecast avoids assuming peak conditions will last forever. Another key principle is internal consistency. Revenue growth, margins, capital turnover, and reinvestment must align logically. If margins rise significantly, what operational improvements support that change? If growth accelerates, where does the demand come from? Every assumption must connect to business reality. Forecasts typically cover a defined explicit period. This period may span several years. During this time, growth gradually transitions toward a stable level. Eventually, the company reaches a mature phase with steady growth and stable returns. This transition is important. No company can grow faster than the economy forever. Sustainable long-term growth must align with broader economic expansion. Assuming perpetual high growth overstates value. Risk must also be considered while forecasting. Uncertainty increases as we look further into the future. Instead of relying on one scenario, it is wise to consider multiple possibilities. Base case, optimistic case, and conservative case provide range. This approach improves decision-making under uncertainty. Transparency is essential. Clear documentation of assumptions allows others to understand and challenge the forecast. Hidden optimism weakens credibility. Explicit reasoning strengthens confidence. Management guidance may provide useful input. However, forecasts should not rely blindly on management targets. Independent judgment ensures objectivity. Forecasting also requires awareness of structural change. Technological shifts, regulation, or changing consumer behavior can alter business models. Assumptions must adapt when environments evolve. Ultimately, forecasting translates strategy into numbers. If management plans expansion into new markets, forecasts must reflect expected revenue and investment. If cost reduction programs are underway, margin projections should incorporate realistic improvements. This chapter emphasizes that forecasting is both analytical and thoughtful. It combines quantitative reasoning with qualitative understanding. It requires humility about uncertainty and discipline about logic. When forecasts are complete, we have projected free cash flows for the explicit period. But most of a company's value often lies beyond that horizon. The next step is estimating continuing value, which captures performance far into the future. Chapter 14. Estimating continuing value. When forecasting performance, we usually project detailed cash flows for a limited number of years. This period may cover the time during which growth gradually slows and returns stabilize. But companies do not stop operating after that explicit forecast period. They continue generating cash long into the future. Capturing this remaining value is the purpose of continuing value. Continuing value often represents a large portion of total valuation. In many cases, it accounts for more than half of enterprise value. Because of this, small changes in assumptions about the distant future can significantly affect results. Care and discipline are essential. The core idea behind continuing value is stability. After a period of transition and growth, a company is assumed to enter a mature phase. In this phase, growth becomes steady and aligned with long-term economic expansion. Return on invested capital stabilizes at a sustainable level. Reinvestment supports ongoing operations without dramatic shifts. The most common method for estimating continuing value uses a perpetual growth framework. This approach assumes that free cash flow grows at a constant rate forever. That growth rate must be realistic and sustainable. No company can grow faster than the overall economy indefinitely. Choosing a modest long-term growth assumption protects against overstatement. The continuing value formula connects free cash flow, growth, and the cost of capital. If growth is higher, continuing value increases. If the cost of capital is higher, continuing value decreases. If free cash flow at the start of the stable period is stronger, value rises. These relationships highlight why disciplined forecasting matters. Another important method is the value driver formula. This approach links continuing value directly to return on invested capital and growth. It reinforces a central principle. Growth creates value only when return on invested capital exceeds the cost of capital. If returns equal the cost of capital, growth does not increase value. If returns fall below the cost of capital, growth reduces value. Because continuing value reflects long-term assumptions, consistency is crucial. If the explicit forecast period shows declining margins and competitive pressure, it would be unrealistic to assume high stable returns afterward. If capital intensity is rising, reinvestment needs must be reflected in stable growth assumptions. Terminal year numbers deserve special attention. The final year of explicit forecasts should represent a normalized state. Margins should reflect sustainable levels. Investment should reflect steady-state conditions. Using temporary peak performance as the base can distort continuing value. Another approach to estimating continuing value involves exit multiples. This method assumes the company could be sold at a market multiple at the end of the forecast period. While practical in some contexts, this method still depends on underlying cash flow expectations. Multiples themselves embed assumptions about growth and risk. Therefore, they should remain consistent with the broader discounted cash flow framework. Sensitivity analysis becomes especially important at this stage. Small variations in long-term growth or cost of capital can change valuation significantly. Testing different scenarios reveals how robust the valuation is to assumption changes. This improves confidence in decision-making. Continuing value estimation also requires humility. The distant future contains uncertainty. Instead of seeking precision, focus on reasonableness. Choose growth rates that reflect economic logic. Align returns with competitive realities. It is helpful to remember that continuing value does not mean infinite growth. It represents the value of stable, ongoing operations beyond the explicit forecast period. The emphasis shifts from rapid expansion to sustainable performance. Companies with strong competitive advantages may sustain returns above the cost of capital for longer periods. Companies in highly competitive industries may see returns gradually converge toward the cost of capital. Understanding industry structure guides these assumptions. At its core, continuing value reinforces the book's central message. Value depends on long-term cash generation and disciplined reinvestment. Short-term fluctuations matter less than sustainable economics. When continuing value is calculated and discounted back to present, it is added to the present value of explicit forecast cash flows. Together, they produce enterprise value. This represents the value of operations as a whole. But one essential piece remains. We must determine the rate at which future cash flows are discounted. That rate reflects risk and opportunity cost. It is known as the cost of capital. Understanding and estimating the cost of capital accurately becomes the next critical step in the valuation journey. Chapter 15. Estimating the cost of capital. Valuation is not only about estimating future cash flows, it is also about understanding risk. Two companies may generate similar cash flows, yet one may be worth less because its future is more uncertain. The cost of capital captures this idea. It represents the return investors require for providing capital to the company. The cost of capital reflects opportunity cost. Investors could place their money elsewhere in assets of similar risk. To attract funding, a company must offer a return that compensates for uncertainty. If the expected return is too low, investors will move their capital to better alternatives. In valuation, the cost of capital is used to discount future free cash flows. The higher the cost of capital, the lower the present value of those cash flows. This relationship reminds us that risk reduces value. The cost of capital has two primary components: the cost of equity and the cost of debt. Equity investors expect compensation for bearing business risk. Debt holders expect interest payments that reflect credit risk. The weighted average of these two components forms the weighted average cost of capital. The cost of equity is typically estimated using a model that links expected return to risk. The model begins with a risk-free rate. This represents the return available from an investment with minimal default risk. It then adds a market risk premium. The market risk premium represents the extra return investors demand for investing in the overall stock market instead of risk-free assets. The final element is a measure of how sensitive the company is to market movements. Companies whose earnings fluctuate more than the market are considered riskier. They require higher expected returns. This sensitivity measure connects company-specific risk to broader market risk. The cost of debt is generally easier to observe. It reflects the interest rate the company pays on its borrowings. However, because interest payments are tax-deductible in many jurisdictions, the effective cost of debt is adjusted for taxes. This adjustment recognizes the benefit of interest deductibility. Once the cost of equity and after-tax cost of debt are determined, they are weighted according to the company's capital structure. If a company uses more debt, debt carries more weight in the calculation. If equity dominates financing, the cost of equity has greater influence. Choosing appropriate weights is important. Market value weights are typically preferred over accounting book values. Market values reflect current investor expectations and risk perceptions. Estimating the cost of capital requires judgment. Risk-free rates change over time. Market risk premiums vary across markets and economic conditions. Company-specific risk measures may fluctuate. Because small changes in the cost of capital can significantly affect valuation, assumptions must be reasonable and consistent. Industry context matters. Companies in stable industries may have lower risk and lower cost of capital. Companies in volatile sectors may require higher expected returns. Geographic exposure can also influence risk. Operating in emerging markets may increase uncertainty and raise the cost of capital. It is also important to distinguish between systematic risk and company-specific risk. Systematic risk affects all companies and cannot be diversified away. Company-specific risk can often be reduced through diversification. The cost of equity focuses primarily on systematic risk because diversified investors are assumed to eliminate company-specific exposure. Another key principle is consistency. Cash flows must match the discount rate. If cash flows are projected in nominal terms, including inflation, the cost of capital must also reflect nominal rates. If cash flows are adjusted for risk directly, the discount rate should not double count that risk. While estimating the cost of capital may seem technical, its economic meaning is simple. It represents the minimum return required to justify investment. If a company earns returns above its cost of capital, value is created. If returns fall below it, value is destroyed. The cost of capital therefore acts as a bridge between performance and valuation. It translates risk into numbers. It connects expectations with reality. When the cost of capital is carefully estimated and applied consistently, we can discount projected free cash flows to present value. Adding the present value of explicit forecasts and continuing value gives enterprise value. From there, we move closer to the perspective most investors care about. How much is the equity worth? How much is each share worth? The next step takes us from enterprise value to value per share, completing the core valuation process. Chapter 16. Moving from enterprise value to value per share. After forecasting free cash flows and discounting them using the cost of capital, we arrive at enterprise value. Enterprise value represents the total value of the company's operations. It reflects the value available to all providers of capital, both debt and equity. But investors who buy shares are concerned with equity value. They want to know what belongs specifically to shareholders after all other claims are satisfied. Moving from enterprise value to value per share completes the core valuation process. The first step is understanding what enterprise value includes. Enterprise value captures the value of operating assets. It excludes non-operating assets and financing obligations. Therefore, adjustments are required before calculating equity value. To arrive at equity value, we begin with enterprise value. Then, we subtract net debt. Net debt equals total debt minus excess cash. Debt represents a claim that must be repaid before shareholders receive value. Excess cash, if not required for operations, belongs to equity holders and is therefore added back indirectly through this adjustment. In addition to debt, other non-equity claims must be considered. These may include unfunded pension obligations, minority interests, or other long-term liabilities. Each represents a claim on enterprise value that reduces what remains for shareholders. Minority interest arises when a company owns less than the entire stake in a subsidiary. If consolidated financial statements include 100% of the subsidiary's performance, but not all of it belongs to the parent, adjustments are needed. The value attributable to minority shareholders must be separated. Similarly, non-operating assets should be added after calculating enterprise value. These may include excess cash beyond operating needs, investments in unrelated businesses, or real estate not used in operations. Such assets increase equity value because they belong to shareholders. Once all adjustments are made, we obtain total equity value. To determine value per share, equity value is divided by the number of diluted shares outstanding. Dilution accounts for stock options, restricted shares, and convertible securities that may increase the share count. Ignoring dilution can overstate per share value. This process may appear mechanical, but each adjustment reflects economic logic. Enterprise value focuses on operations independent of financing. Equity value reflects what remains after satisfying all other claims. Accuracy in this stage requires careful attention to detail. Debt should be measured at market value when possible. Off-balance sheet obligations should be identified and included. Short-term and long-term borrowings must both be considered. The timing of shares outstanding also matters. Share repurchases or issuances can change ownership structure. Valuation must reflect the current share count, consistent with projected performance. Another important concept is reconciliation with market price. Once value per share is calculated, it can be compared with the current market price. If intrinsic value exceeds market price, the stock may be undervalued. If intrinsic value is below market price, expectations embedded in the market may be too optimistic. However, valuation is not about finding exact numbers. It is about understanding what assumptions justify the current price. By analyzing equity value per share, investors can identify which variables drive differences between intrinsic value and market price. Sensitivity analysis plays a useful role here. Changing growth rates, margins, or cost of capital will affect enterprise value and equity value. Observing how per-share value responds to these changes deepens understanding of risk and opportunity. It is also helpful to examine implied expectations. If market price is significantly higher than intrinsic value based on conservative assumptions, it suggests investors expect stronger growth or higher returns than currently forecast. This insight shifts the conversation from price to performance expectations. Moving from enterprise value to value per share also highlights the impact of capital structure decisions. Increasing debt may reduce equity value if risk rises. Share repurchases may increase per share value if shares are bought below intrinsic value. These financial choices influence distribution of value, but do not create value unless operating performance improves. This chapter reinforces a central theme. Valuation begins with operations, but ends with shareholders. Understanding the full path from free cash flow to per-share value ensures clarity at every stage. When enterprise value is carefully adjusted and divided by diluted shares, we obtain a measure that investors can compare directly with market prices. Yet valuation does not end here. After calculating per-share value, we must analyze the results and interpret what they mean. The next chapter focuses on examining outcomes, testing assumptions, and drawing thoughtful conclusions from the valuation process. Chapter 17. Analyzing the results. After completing the valuation model and calculating value per share, many people feel finished. They see a final number and immediately compare it with the market price. But valuation does not end with a number. In fact, the most important thinking begins after the calculation is complete. Analyzing the results means understanding what drives the outcome. It means asking why the value is high or low. It means testing whether the assumptions are reasonable. The first step is identifying the main value drivers. Which variables have the greatest impact on enterprise value? Is value most sensitive to revenue growth? Does operating margin play a larger role? Is the cost of capital the most powerful influence? Recognizing these drivers shifts attention from outputs to inputs. Sensitivity analysis becomes a central tool. By adjusting one assumption at a time, we observe how value changes. If a small change in long-term growth dramatically alters valuation, that assumption requires careful scrutiny. If results remain stable across a range of assumptions, confidence increases. Another helpful approach is scenario analysis. Instead of changing one variable at a time, we create coherent scenarios. A conservative scenario may assume slower growth and stable margins. An optimistic scenario may assume stronger demand and efficiency improvements. Comparing scenarios reveals the range of possible outcomes. Analyzing results also involves comparing intrinsic value with market price. If intrinsic value is higher than market price, the market may be underestimating future performance. If intrinsic value is lower, the market may expect stronger growth or profitability than assumed. This comparison does not guarantee investment decisions, but it clarifies expectations. It is equally important to review the logic behind assumptions. Were growth forecasts consistent with industry trends? Were margin improvements supported by operational plans? Was reinvestment aligned with expansion expectations? Every number in the model reflects a story about the future. Analyzing results means evaluating the credibility of that story. Another useful perspective is reverse engineering the valuation. Instead of asking what the company is worth, we ask what performance is required to justify the current market price. This approach reveals embedded expectations. If the required growth appears unrealistic, caution may be warranted. If expectations seem conservative, opportunity may exist. Comparing valuation multiples implied by the model can also provide insight. For example, what price-to-earnings ratio does the intrinsic value suggest? How does that compare with industry averages? If the implied multiple appears extreme, assumptions may need review. Analyzing results should also consider qualitative factors. Does the company possess durable competitive advantages? Is management disciplined in capital allocation? Are industry dynamics stable or rapidly changing? Numbers alone cannot capture all dimensions of value. Communication is another part of analysis. When presenting valuation results to decision makers, clarity matters. Explain key assumptions clearly. Highlight areas of uncertainty. Avoid presenting the valuation as precise or certain. Transparency builds trust and improves discussion. It is important to remember that valuation is a tool for decision-making, not prediction. The goal is not to forecast the exact future. The goal is to structure thinking about risk and return. A thoughtful analysis may reveal areas where further research is needed. Perhaps customer demand trends require deeper study. Perhaps competitive threats deserve more attention. Valuation can guide investigation rather than conclude it. This chapter emphasizes humility and discipline. Even the most detailed model rests on assumptions. Recognizing uncertainty prevents overconfidence. Testing assumptions strengthens credibility. When analysis is complete, valuation transforms from a static number into a dynamic framework for thinking. It helps managers allocate capital wisely. It helps investors evaluate opportunities rationally. It encourages decisions grounded in economics rather than emotion. Yet one additional perspective often complements discounted cash flow analysis. Multiples provide a quick way to compare companies and cross-check results. Used properly, they enhance understanding rather than replace disciplined valuation. The next chapter explores how to use multiples effectively and responsibly within a sound valuation framework. Chapter 18. Using multiples. After building a full discounted cash flow valuation, many analysts turn to multiples. Multiples are widely used in markets. They appear in headlines, analyst reports, and investment discussions. They offer a quick way to compare companies. But while multiples are simple in appearance, they require careful interpretation. A multiple expresses value relative to a financial measure. Common examples include price to earnings and enterprise value to earnings before interest and taxes. These ratios allow investors to compare companies of different sizes. Instead of focusing on absolute price, multiples focus on price relative to performance. The appeal of multiples lies in their simplicity. They are easy to calculate. They are easy to communicate. They provide a fast benchmark. However, simplicity can hide complexity. Behind every multiple lies an assumption about growth, profitability, risk, and return on capital. For example, a high price-to-earnings ratio often reflects expectations of strong future growth or high returns. A low multiple may signal slower growth, higher risk, or weak profitability. Without understanding these drivers, comparisons can mislead. Multiples should never replace discounted cash flow analysis. Instead, they should complement it. Discounted cash flow reveals intrinsic value based on explicit assumptions. Multiples provide a market-based perspective that reflects how similar companies are currently valued. Selecting the right multiple is important. For companies with stable earnings and moderate debt, price to earnings may be appropriate. For companies with varying capital structures, enterprise value-based multiples provide better comparability. Enterprise value neutralizes differences in debt levels, allowing focus on operating performance. It is also critical to compare companies with similar characteristics. Growth rates, margins, capital intensity, and risk profiles should align. Comparing a high-growth technology firm with a mature utility using the same multiple may lead to incorrect conclusions. Multiples are influenced by market conditions. During optimistic periods, market-wide multiples may expand. During uncertain times, they may contract. Understanding the broader market environment provides context. Another useful concept is the implied multiple from discounted cash flow valuation. Once intrinsic value is calculated, we can derive the corresponding price to earnings or enterprise value multiple. If the implied multiple differs significantly from market comparables, it signals that assumptions may differ. This comparison deepens insight. Multiples also require normalization. Temporary peaks or troughs in earnings can distort ratios. Using normalized earnings smooths out unusual effects and creates fairer comparisons. Cyclical industries particularly require careful normalization. Forward-looking multiples often provide better perspective than historical ones. Markets value companies based on expected future performance. Therefore, using forecasted earnings may better reflect expectations. However, forecasts must remain realistic. Multiples can also be used in transaction analysis. In mergers and acquisitions, transaction multiples reveal how much buyers have paid for similar companies. These benchmarks provide reference points, but must account for differences in timing and conditions. One risk in using multiples is circular reasoning. If analysts justify a high multiple simply because the market assigns it, they may overlook underlying fundamentals. Multiples should be interpreted through the lens of value drivers. A disciplined approach asks key questions. Why does this company deserve a higher multiple? Is growth sustainable? Are returns on invested capital strong? Is risk lower than peers? These questions anchor multiples in economics rather than fashion. Another consideration is capital structure impact. Companies with higher leverage may show different price-based multiples compared with enterprise value-based multiples. Understanding how debt influences valuation ratios ensures fair comparison. Multiples provide speed, but not depth. They offer perspective, but not complete explanation. When used alongside discounted cash flow, they strengthen confidence in valuation conclusions. This chapter highlights balance. Relying solely on complex models may overlook market signals. Relying solely on multiples may ignore intrinsic value logic. Combining both approaches creates a fuller picture. In practice, many professionals begin with discounted cash flow to establish intrinsic value. They then use multiples to cross-check results and assess market sentiment. When both methods align, confidence increases. When they diverge, further analysis is required. Ultimately, multiples remind us that valuation is both analytical and comparative. Companies do not exist in isolation. They operate within industries and markets. Understanding relative positioning enhances judgment. With multiples understood, the next step addresses situations where companies operate in multiple distinct businesses. In such cases, valuing the company as a single unit may hide important differences. This leads to the method known as valuation by parts. Chapter 19: Valuation by Parts. Many companies are not single businesses. They operate across different industries, geographies, or product lines. Each segment may have unique growth prospects, risk levels, and capital requirements. Valuing such a company as one uniform entity can hide important differences. Valuation by parts addresses this complexity. The core idea is simple. Instead of valuing the entire company using one set of assumptions, we value each business segment separately. Then we combine the individual values to determine total enterprise value. This approach often reveals insights that a single blended model cannot provide. Consider a company with two divisions. One division operates in a mature industry with stable cash flows. The other division is a high-growth digital platform with strong expansion potential. If we apply average growth and margin assumptions to the entire company, we may misrepresent both businesses. Valuation by parts allows each segment to be evaluated according to its own economic reality. The first step is identifying clearly defined operating segments. Financial disclosures often provide segment-level revenue and profit information. Each segment should be analyzed as if it were a standalone company. Revenue growth, operating margins, and capital intensity may differ significantly across segments. Next, we estimate free cash flows for each segment individually. This requires allocating invested capital appropriately. Shared assets and corporate overhead must be assigned carefully to avoid distortion. Consistency in allocation improves credibility. After forecasting segment cash flows, each segment is valued using discounted cash flow analysis. If segments operate in different industries or geographies, cost of capital may vary between them. Higher risk segments require higher discount rates. Applying a single cost of capital to all segments may misprice risk. Once enterprise value is calculated for each segment, the values are added together. Non-operating assets and corporate liabilities are then adjusted at the consolidated level. The final result reflects total enterprise value, derived from individual business economics. Valuation by parts is especially useful when companies plan restructuring or divestitures. If one division consistently earns returns below the cost of capital, separating it may unlock value. If a high-growth segment is hidden within a larger mature company, standalone valuation may reveal greater worth. This method also helps investors understand conglomerates. Large diversified companies may trade at a discount because their complexity reduces transparency. Breaking the company into parts can clarify where value is created and where it is diluted. However, valuation by parts requires careful judgment. Segment-level financial data may be limited. Allocating shared costs can introduce subjectivity. Interdependencies between segments must be considered. For example, one division may support another through shared distribution or brand strength. Ignoring such connections may overstate standalone value. Synergies also matter. Some businesses benefit from operating together. Shared technology, procurement advantages, or customer relationships may enhance performance. Valuing segments entirely independently could overlook these benefits. Despite these challenges, valuation by parts offers powerful insight. It encourages analysts to look beyond aggregated numbers. It highlights differences in return on invested capital across segments. It reveals which businesses deserve more capital allocation. This approach reinforces a central principle of valuation. Value depends on economic performance, not size alone. A smaller segment with strong returns and growth may contribute more to intrinsic value than a larger but less efficient division. Valuation by parts also supports strategic decision-making. Management can evaluate whether to invest, restructure, or divest particular units. Capital can be redirected towards segments that create the most value. From an investor perspective, understanding segment economics improves interpretation of market price. If the sum of parts exceeds the current market value, the company may be undervalued. If certain segments destroy value, expectations may need adjustment. This chapter emphasizes clarity and granularity. Instead of treating the company as a single block, valuation by parts recognizes diversity within operations. It aligns analysis more closely with real-world complexity. With this chapter, the core valuation techniques are complete. We have moved from frameworks to financial reorganization, performance analysis, forecasting, continuing value, cost of capital, equity value, result interpretation, multiples, and segment valuation. The next part of the journey explores advanced valuation techniques. These topics address special accounting items, taxes, leases, and other complexities that influence value. Imagine two analysts valuing the same company. Both use the same financial statements. Both use the same forecasting period. Both apply the same valuation model. Yet their final valuations are very different. Why does this happen? The difference often does not come from the main framework. It comes from the details hidden inside the business. Taxes, accounting adjustments, leases, retirement obligations, inflation, international risks. These elements may look small at first, but in valuation, small details can change the entire picture. In the previous parts of this journey, we built the foundation. We learned the principles that create value. We explored how returns, growth, and risk shape the worth of a company. Then we moved into the practical tools used to measure that value. We reorganized financial statements. We analyzed performance. We forecasted future results and estimated continuing value. We learned how to move from enterprise value to value per share. Now the journey moves deeper. Real companies are rarely simple. They operate across countries. They follow different accounting practices. They carry obligations that are not always visible on the surface. They face inflation, taxes, and financial structures that can distort performance. A basic valuation model may capture the broad story of a business, but advanced valuation techniques help reveal the true economics behind the numbers. For example, taxes directly influence how much cash a company actually keeps. Leases often behave like hidden debt, even though they may appear differently in financial statements. Retirement obligations can represent large long-term commitments that reduce future cash flow. Ignoring these elements can lead to a misleading valuation. This section focuses on identifying those hidden layers. It teaches how to adjust financial statements so they better reflect economic reality. It explains how to measure performance in modern capital-light companies where traditional metrics may fail. It also explores how inflation and cross-border differences affect valuation assumptions. These techniques help analysts move from a rough estimate toward a more refined understanding of value. They do not change the core principles introduced earlier. Instead, they strengthen them by making the analysis more accurate and more realistic. Think of valuation like examining a complex machine. In the earlier sections, we learned how the machine works and how to measure its overall output. Now we begin opening the smaller compartments inside the machine. We look at the hidden gears that influence performance in subtle but powerful ways. Understanding these details allows investors, managers, and analysts to see beyond surface numbers. It helps them identify risks earlier and recognize opportunities others may overlook. And the first hidden layer we must understand is one of the most powerful forces in finance: taxes. Taxes influence cash flow, investment decisions, and capital structure. They shape how value is created and distributed. Ignoring taxes can significantly distort valuation results. That is why the first chapter of this part begins with a fundamental topic. Chapter 20. Taxes. Taxes are one of the most powerful forces affecting business value. Every company generates profit through its operations. But the profit that truly belongs to investors is the amount that remains after taxes are paid. Because of this, understanding taxes is essential in valuation. At first glance, taxes may look simple. A company earns profit and then pays a percentage of that profit to the government. However, real business taxation is rarely that straightforward. Different countries apply different rules. Companies may receive deductions, credits, and incentives. Accounting profits and taxable profits may also be different. For valuation, what matters most is the actual cash taxes the company expects to pay in the future. Cash taxes directly affect free cash flow, which is the foundation of company valuation. If taxes increase, cash flow decreases and value falls. If taxes decrease, more cash remains for investors and value rises. One important idea in valuation is the concept of the marginal tax rate. The marginal tax rate represents the rate applied to the next unit of profit. This rate is often more useful than the average tax rate reported in financial statements. The average rate may reflect temporary differences or past adjustments. The marginal rate better reflects the taxes a company will likely pay on future earnings. Another important concept is the tax shield created by interest payments. Interest on debt is often tax deductible in many countries. This means that borrowing money can reduce the amount of taxable income. When a company pays interest on debt, its tax bill becomes smaller. This effect increases the total value of the company because it allows more cash to remain inside the business. However, debt also increases financial risk. Too much borrowing can create instability during difficult periods. Therefore, companies must balance the benefits of tax savings with the risks of higher debt. Taxes also influence how companies structure their operations across countries. Large international companies often operate in many tax jurisdictions. Each country has its own tax policies and rules. These differences can influence where companies locate assets, intellectual property, and production facilities. When analysts perform valuation, they must consider how taxes affect future cash flows. Temporary tax benefits should not be assumed to last forever. Similarly, temporary tax penalties should not be assumed to continue indefinitely. The goal is to estimate a sustainable tax level that reflects the company's long-term operating environment. Another challenge arises from deferred taxes. Financial statements often include deferred tax assets and liabilities. These represent timing differences between accounting rules and tax rules. For example, a company may recognize revenue today but pay tax on it later. Or it may deduct expenses earlier for tax purposes than for accounting purposes. These timing differences do not necessarily change the total taxes paid over time, but they affect when the cash payments occur. Since valuation focuses on cash flow, the timing of taxes becomes important. In the end, taxes remind us that value is always measured in after-tax cash flows. A company may report impressive profits, but if a large portion goes to taxes, the remaining value for investors becomes smaller. Careful tax analysis ensures that valuation reflects economic reality rather than accounting appearance. Understanding taxes prepares us to examine other hidden financial elements that affect value. One of those elements involves items that do not belong to core operations, but still influence financial statements. The next chapter explores these adjustments in detail. Chapter 21. Non-operating items, provisions, and reserves. When people first look at a company's financial statements, everything appears to belong to the same story. Revenue grows, costs appear, profit is calculated. At the end, the company reports earnings. But in reality, not every number inside the financial statements represents the core business. Some items come from activities that are not part of daily operations. Others represent estimates about future events. Some reflect accounting adjustments rather than real economic activity. These elements are called non-operating items, provisions, and reserves. Understanding them is essential for accurate valuation. The main goal of valuation is to measure the value created by the company's operating business. That means the activities that produce goods or services and generate cash flow for the future. If analysts mix operating performance with unrelated financial items, the picture of the business becomes distorted. Non-operating items are gains or losses that do not come from the company's main activities. For example, a company might sell a piece of land and record a large profit. Another company might record a loss after selling an investment. These events affect accounting profit in the year they occur, but they do not represent the normal operating performance of the business. If analysts treat these events as part of regular operations, they may incorrectly assume the company is more profitable than it truly is. Therefore, valuation requires separating operating results from non-operating effects. Another important category is provisions. Provisions represent estimates of future costs that the company expects to face. For example, a company may expect warranty costs for products sold today. It may expect future legal settlements or restructuring costs. Accounting rules require companies to recognize these expected costs before the actual cash payment occurs. While provisions are useful for accounting, they can complicate valuation. Some provisions represent real economic obligations. Others reflect management estimates that may change over time. Analysts must evaluate whether provisions represent genuine future costs related to operations or temporary accounting adjustments. Reserves are closely related to provisions. They represent funds set aside to cover expected future losses or expenses. Examples may include reserves for bad loans, inventory write-downs, or future repairs. In some industries, reserves play an important role in managing uncertainty. Banks, for example, often create reserves to cover potential loan losses. These reserves help absorb financial shocks and provide stability. However, reserves can also make financial statements harder to interpret. Management has some discretion in determining the size and timing of these reserves. Increasing reserves can reduce reported profit today, while creating the possibility of higher profits in the future when reserves are released. Because of this flexibility, analysts must carefully evaluate how reserves affect reported earnings. The goal is to understand the true economic performance of the business rather than the accounting presentation. When performing valuation, the key principle is to focus on sustainable operating cash flow. Non-operating gains and losses should usually be removed from operating performance. Provisions should be examined to determine whether they represent real future obligations. Reserves should be analyzed to ensure they reflect genuine risk rather than temporary accounting choices. Another challenge appears when non-operating assets exist inside the company. Some businesses hold investments, excess cash, or real estate that are not required for daily operations. These assets may generate income or gains that appear in the financial statements. While these assets have value, they should usually be treated separately from the operating business. Analysts often calculate the value of the operating business first and then add the value of non-operating assets afterward. This approach keeps the valuation clean and transparent. It ensures that the operating performance of the company is evaluated independently from unrelated assets. The process of adjusting financial statements may seem technical at first, but its purpose is simple. It allows analysts to see the real economic engine of the company. Once the noise created by accounting adjustments is removed, the underlying business becomes easier to understand. These adjustments also improve comparability. Different companies may use different accounting choices for provisions and reserves. By adjusting these items, analysts can compare businesses on a more consistent basis. In valuation, clarity is power. The more clearly we separate operating performance from accounting noise, the more reliable our analysis becomes. Once these adjustments are understood, we can move to another important area that often hides financial obligations. Many companies rely heavily on leases to operate their businesses. These leases may look like simple rental agreements, but economically, they often behave like debt. Understanding how leases influence valuation is the focus of the next chapter. Chapter 22. Leases. Many companies depend on assets to run their operations. Retail companies need stores. Airlines need aircraft. Logistics companies need warehouses and vehicles. Hotels need buildings and property. In many cases, companies do not purchase these assets directly. Instead, they lease them. A lease allows a company to use an asset for a period of time in exchange for regular payments. At first glance, leasing appears simple. The company rents the asset and pays a regular fee. But from a valuation perspective, leases are more complex. Economically, a lease often behaves very much like borrowing money. When a company signs a long-term lease, it commits to making payments for many years. These payments represent a financial obligation similar to debt. The company receives the benefit of using the asset today and promises to make payments in the future. Because of this similarity, analysts must treat many leases in a way that reflects their true economic meaning. Ignoring leases can lead to an incomplete picture of a company's financial position. In the past, some accounting systems treated leases as simple operating expenses. Lease payments appeared as regular costs on the income statement. The asset being used and the long-term obligation were not always visible on the balance sheet. This made some companies appear less leveraged than they truly were. A business might show low debt while still having large future lease commitments. Modern accounting rules attempt to address this issue by bringing many leases onto the balance sheet. Companies now recognize a right-to-use asset that represents the ability to use the leased property. They also recognize a lease liability that reflects the future payments they must make. Even with these improvements, analysts must still understand how leases influence valuation. The first step is recognizing that lease payments contain two economic components. One part represents the cost of financing the asset. The other part represents the depreciation of the asset over time. When analysts evaluate operating performance, they often separate these two components. This allows the business to be analyzed in a way that is comparable to companies that purchase assets directly with debt financing. For example, imagine two retail companies. One company owns its stores and finances them with debt. Another company leases its stores instead of buying them. If analysts treat the lease payment purely as an operating expense, the leased company may appear less profitable or less leveraged than the company that owns its stores. But economically, the two businesses may be very similar. Adjusting leases allows analysts to compare companies more fairly. Another important effect of leases appears in capital invested in the business. When companies use leased assets, they are still relying on capital to generate revenue. Even if the company does not legally own the asset, the business depends on it for operations. Therefore, leased assets should be considered when measuring the capital used by the company. This ensures that return on invested capital reflects the true resources required to run the business. Leases also affect financial risk. Because lease payments must be made regularly, they represent fixed obligations similar to interest payments on debt. During difficult economic periods, these obligations can place pressure on cash flow. Companies with large lease commitments may face challenges if revenue declines. This is why analysts include lease liabilities when evaluating leverage and financial stability. Another important consideration is the length and structure of lease agreements. Some leases extend for many years and include renewal options. Others are shorter and provide more flexibility. Longer leases create more predictable operating conditions, but also reduce flexibility. Shorter leases allow companies to adapt more easily, but may introduce uncertainty about future costs. Understanding these details helps analysts evaluate how stable the company's cost structure may be over time. From a valuation perspective, the key principle remains consistent. The goal is to capture the true economic obligations and resources of the company. Leases represent long-term commitments that support the company's operations. Therefore, they must be incorporated into financial analysis and valuation models. By adjusting for leases, analysts gain a clearer picture of the company's capital structure, operating efficiency, and risk profile. This leads to a more accurate estimate of enterprise value. However, leases are only one type of long-term obligation that companies carry. Another important obligation involves commitments made to employees for retirement benefits. These obligations can be large and complex, and they often extend many years into the future. Understanding how retirement obligations influence valuation is the focus of the next chapter. Chapter 23: Retirement Obligations. Companies do not only invest in buildings, machines, and technology, they also invest in people. Employees contribute skills, experience, and effort that allow the business to operate and grow. In return, companies provide salaries, benefits, and sometimes retirement plans. Retirement benefits represent a promise. The company promises to provide financial support to employees after they stop working. These promises are often made many years before the payments actually occur. Because of this long time horizon, retirement obligations become an important issue in valuation. Many large companies offer pension plans or other retirement programs. Under these arrangements, employees earn retirement benefits while they are working. The company sets aside resources to fund these future payments. Over time, these obligations can become large. They represent a commitment that must eventually be paid, often many years into the future. For this reason, retirement obligations behave like long-term liabilities. However, measuring these obligations is not simple. Unlike regular debt, pension obligations depend on several assumptions. These assumptions include employee life expectancy, future salary levels, and expected investment returns on pension assets. Small changes in these assumptions can significantly change the estimated size of the obligation. Because of this uncertainty, analysts must examine retirement obligations carefully when performing valuation. One important concept is the difference between the pension obligation and the pension assets. Companies often invest money into pension funds to cover future payments. These investments may include stocks, bonds, or other financial assets. If the value of pension assets equals the pension obligation, the plan is fully funded. If the assets are lower than the obligation, the company faces a pension deficit. If the assets exceed the obligation, the company has a pension surplus. A pension deficit represents a real financial obligation. In economic terms, it is similar to debt because the company must eventually provide the missing funds. Therefore, analysts usually treat pension deficits as liabilities when evaluating the financial position of a company. Another challenge arises because pension accounting can create volatility in financial statements. Changes in interest rates, market performance, and actuarial assumptions can affect reported pension values. These changes may cause profits to rise or fall, even though the core operations of the business remain unchanged. For valuation purposes, the focus should remain on the economic reality behind these numbers. The key question is simple. What long-term obligation does the company truly owe to its employees? To answer this question, analysts often adjust financial statements to separate operating performance from pension-related effects. Operating profit should reflect the performance of the business itself. Pension-related financing elements can then be analyzed separately. Another important issue involves pension contributions. Companies may contribute cash to pension funds over time to meet their obligations. These contributions reduce free cash flow available to investors. When estimating future cash flow, analysts must consider the likely contributions required to maintain pension plans. Ignoring these contributions would overstate the cash that the business can generate for investors. Retirement obligations also influence risk. Companies with large pension deficits may face pressure if investment returns fall, or if employees live longer than expected. During economic downturns, these obligations can become difficult to manage. This is why investors and analysts pay close attention to the funding status of pension plans. A well-funded pension plan reduces financial uncertainty. A poorly funded plan may represent a hidden liability that affects valuation. In the end, retirement obligations remind us that businesses carry responsibilities beyond traditional financial debt. Promises made to employees represent long-term commitments that must be honored. Understanding these commitments helps analysts see the full financial picture of a company. By including retirement obligations in valuation analysis, we gain a clearer view of both risk and financial strength. Yet not all companies rely heavily on physical assets or long-term employee benefit programs. In many modern industries, value is created through software, platforms, and intellectual property rather than factories and heavy equipment. These businesses operate with very little physical capital but can still generate enormous value. Traditional performance metrics may not fully capture their economics. The next chapter explores how to measure performance in these modern businesses. Chapter 24: Measuring Performance in Capital-Light Businesses. For many years, the structure of most businesses was easy to understand. Companies built factories. They purchased machines. They invested large amounts of money in physical assets. These assets produced goods that were sold to customers. In this traditional model, the relationship between capital and revenue was clear. A company invested capital, used that capital to produce products, and generated profit. Because of this clear structure, financial metrics such as return on invested capital worked very well. However, the modern economy has introduced a new type of business. Many companies today operate with very little physical capital. Instead, they rely on software, data, platforms, and intellectual property. Technology companies, digital platforms, and online service providers often fall into this category. These businesses can grow rapidly without building large factories or purchasing heavy equipment. Their most valuable assets may be algorithms, networks of users, or brand recognition. Because these businesses require less physical capital, traditional financial analysis can sometimes become misleading. For example, a digital platform might invest heavily in research, software development, and marketing. Accounting rules often treat these investments as expenses rather than long-term assets. As a result, the financial statements may show lower profits in the early years, even though the company is building valuable capabilities. From an economic perspective, these investments may behave more like capital investments. They create systems and networks that generate revenue for many years. This creates a challenge for analysts performing valuation. If important investments are treated as simple expenses, the company may appear less profitable than it truly is. At the same time, the amount of invested capital may appear smaller than the resources actually used to build the business. Because of this issue, analysts sometimes adjust financial statements to better reflect economic reality. Certain investments, such as software development or customer acquisition, may be treated as long-term investments rather than short-term costs. By doing this, analysts can estimate a more realistic level of invested capital and operating performance. Another important feature of capital-light businesses is scalability. Once the core technology or platform is developed, the cost of serving additional customers may be very small. A software product can be sold to millions of users without the need for millions of factories. This scalability allows revenue to grow much faster than operating costs. As a result, profit margins may increase dramatically as the company expands. Network effects can also play an important role. In some digital businesses, the value of the service increases as more users join the platform. This can create powerful competitive advantages and long-term value creation. However, these advantages also introduce new uncertainties. Technology changes quickly. Customer preferences evolve. New competitors may emerge with innovative solutions. Because of these risks, analysts must examine both the growth potential and the durability of competitive advantage. Another factor to consider is intangible capital. In many modern businesses, the most valuable assets are not physical objects. They may include software, patents, data, brand recognition, or customer relationships. These assets are often difficult to measure directly on financial statements. Yet, they can be the primary drivers of long-term value. Valuation therefore requires a deeper understanding of how these intangible assets contribute to future cash flow. The key principle remains consistent with earlier chapters. Value is created when returns exceed the cost of capital. But in capital-light businesses, both the measurement of capital and the measurement of returns require careful interpretation. By adjusting financial statements and focusing on the underlying economics, analysts can better evaluate these modern companies. This approach helps reveal the real drivers of growth, profitability, and long-term value. Even with these adjustments, analysts still rely heavily on return on capital as a core measure of performance. However, there are several different ways to measure return on capital depending on the situation and the type of business being analyzed. The next chapter explores these alternative approaches and explains how different return measures can provide deeper insight into company performance. Chapter 25. Alternative ways to measure return on capital. Return on capital is one of the most powerful ideas in finance. It answers a simple but important question. How efficiently is a company using the money invested in its business? Earlier, we learned that value is created when a company earns returns greater than its cost of capital. If returns exceed the cost of capital, the company creates value for investors. If returns fall below the cost of capital, the company destroys value even if it reports accounting profits. Because of this relationship, measuring return on capital correctly is essential in valuation. The most widely used metric is return on invested capital. This measure compares operating profit after tax with the total capital invested in the business. It captures how effectively management uses both debt and equity capital to generate operating returns. Return on invested capital works well in many situations. However, businesses operate in different ways, and no single metric can perfectly capture performance in every industry. For this reason, analysts often consider alternative measures of return on capital to gain deeper insight. One commonly used measure is return on equity. Return on equity compares net income with shareholder equity. It focuses on the returns generated specifically for the owners of the company. While this measure is widely used, it can sometimes be misleading. Financial leverage can increase return on equity, even if the underlying business performance has not improved. If a company increases debt while equity remains smaller, return on equity may rise simply because the denominator becomes smaller. Therefore, analysts must interpret return on equity carefully and consider the effect of leverage. Another useful metric is return on assets. This measure compares net income with the total assets of the company. It provides insight into how efficiently the company uses all of its resources. However, return on assets also has limitations. Accounting rules influence how assets are recorded on the balance sheet. Some intangible investments, such as research or brand building, may not appear as assets, even though they contribute strongly to value creation. Because of these differences, return on assets may not always reflect the true economic resources used by the business. Another approach used in valuation is economic profit. Economic profit measures the value created after accounting for the cost of capital. It begins with operating profit after tax, and then subtracts a charge for the capital invested in the business. If economic profit is positive, the company creates value. If economic profit is negative, the company destroys value. This measure helps connect operational performance with shareholder value in a very direct way. Instead of simply measuring profit, economic profit measures whether the company earns more than investors require for the risk they take. Another variation is cash return on invested capital. This approach focuses on cash flow rather than accounting profit. Cash flow often provides a clearer picture of economic performance because it removes many accounting adjustments that influence reported earnings. For companies with large non-cash expenses, such as depreciation or amortization, cash-based measures can provide additional insight into the true performance of the business. Different industries may also require specialized metrics. For example, financial institutions may rely on measures related to capital adequacy and risk-adjusted returns. Technology companies may focus on metrics connected to customer acquisition and lifetime value. The purpose of these alternative measures is not to replace the core concept of return on capital. Instead, they provide additional perspectives that help analysts understand performance from different angles. By comparing multiple measures of return, analysts can identify patterns and detect potential distortions in financial statements. If several measures tell a consistent story, confidence in the analysis increases. In the end, all these measures connect back to the same fundamental idea. Capital is a scarce resource. Investors expect that the companies they support will use that capital wisely. Measuring returns helps determine whether those expectations are being met. However, even the best return metrics must be interpreted in the context of the economic environment. One powerful force that can influence financial performance and valuation assumptions is inflation. Inflation changes the value of money over time. It affects costs, pricing, interest rates, and investment decisions. Ignoring inflation can distort financial analysis and lead to incorrect conclusions. The next chapter explores how inflation influences valuation and how analysts adjust their models to account for changing price levels. Chapter 26. Inflation. Inflation is one of the most important economic forces affecting businesses and investors. It represents the general increase in prices over time. As inflation rises, the purchasing power of money falls. The same amount of money buys fewer goods and services in the future. For companies and investors, this simple idea has powerful consequences. Inflation influences costs, revenues, interest rates, and investment decisions. Because valuation depends on estimating future cash flows, understanding inflation becomes essential. At first, inflation may appear easy to include in financial forecasts. Analysts might assume that prices will simply rise at a steady rate each year. However, the real effects of inflation are more complex. Inflation affects both the operating performance of companies and the financial assumptions used in valuation models. One of the first areas affected by inflation is revenue. In many industries, companies can raise prices as inflation increases. If the company has strong competitive advantages, it may pass higher costs to customers through higher prices. However, not all companies have this power. Some businesses operate in highly competitive markets where raising prices is difficult. In such situations, inflation may increase costs faster than revenues. This can reduce profit margins and weaken performance. Costs are another area strongly influenced by inflation. The price of raw materials, labor, transportation, and energy may rise during inflationary periods. If these costs increase faster than sales prices, profitability declines. Capital investment is also affected. When inflation increases, the cost of building factories, purchasing equipment, or developing infrastructure rises. Companies may need to invest more money just to maintain the same level of operations. This means that capital requirements can grow even if the company's real production does not change. Ignoring this effect may lead analysts to underestimate future investment needs. Inflation also influences interest rates and the cost of capital. Investors demand higher returns when inflation is high because future cash flows are worth less in real terms. As a result, borrowing costs and required equity returns often rise during inflationary periods. This change directly affects valuation. Higher discount rates reduce the present value of future cash flows. Even if the company generates strong growth, the value of those future profits may decline if inflation drives interest rates upward. Another challenge appears when analysts mix real and nominal assumptions. Real values remove the effect of inflation. Nominal values include inflation in the numbers. For example, revenue forecasts may include inflation, while the discount rate may not. This inconsistency can produce incorrect valuation results. To avoid this problem, analysts must maintain consistency throughout the model. If forecasts include inflation, the discount rate must also include inflation. If forecasts are expressed in real terms, the discount rate should also be expressed in real terms. Inflation can also affect accounting numbers reported in financial statements. Assets purchased many years ago may be recorded at historical cost. During periods of high inflation, the real value of those assets may differ significantly from their recorded values. This can distort financial ratios and performance measures. Analysts must recognize these distortions when interpreting historical data. Certain industries are particularly sensitive to inflation. Companies with large inventories or long-term fixed price contracts may experience significant challenges when prices change rapidly. On the other hand, some businesses benefit from inflation. Companies that own valuable real assets, such as natural resources or real estate, may see the value of those assets increase as prices rise. Because of these diverse effects, analysts must examine how inflation influences each company's specific business model. In valuation, the goal is not simply to predict inflation perfectly. Instead, analysts aim to understand how inflation interacts with revenue growth, operating costs, capital investment, and financing conditions. By incorporating these relationships into financial forecasts, analysts can create valuation models that better reflect economic reality. However, inflation is not the only macroeconomic factor influencing valuation. In a global economy, many companies operate across multiple countries and currencies. When businesses expand internationally, analysts must deal with additional complexities such as exchange rates, political risk, and differences in financial markets. Understanding how to evaluate companies that operate across national boundaries is the focus of the next chapter. Chapter 27. Cross-Border Valuation. In the modern world, many companies no longer operate in only one country. A company may design products in one nation, manufacture them in another, and sell them across dozens of markets. Technology companies may serve millions of customers around the world through digital platforms. Large corporations often generate revenue in many different currencies. Because of this global expansion, valuation increasingly requires a cross-border perspective. Analyzing a company that operates across multiple countries introduces new challenges that do not appear in purely domestic businesses. One of the first challenges involves currency. Each country uses its own currency, and exchange rates constantly change. When a company earns revenue in one currency, but reports financial results in another, those currency movements affect the reported numbers. For example, a company based in one country may generate strong sales in another country. If the foreign currency weakens relative to the home currency, the reported revenue may decline, even though the underlying business remains strong. Analysts must therefore decide which currency to use when building valuation models. Forecasts, cash flows, and discount rates must all be expressed in the same currency to maintain consistency. Another important issue is inflation differences between countries. Some economies experience stable prices, while others may face higher inflation. These differences influence interest rates, wages, and operating costs. When analysts forecast revenue and expenses for international operations, they must consider the local economic environment rather than assuming uniform conditions across all markets. Political and regulatory risks also play an important role in cross-border valuation. Governments may change regulations, tax policies, or trade rules that affect how businesses operate. In some regions, political instability may create uncertainty about future investments. These risks can influence the cost of capital required by investors. Higher uncertainty usually leads investors to demand higher expected returns. This increases the discount rate used in valuation models and may reduce the estimated value of the business. Another challenge appears when financial markets differ across countries. Some markets have deep and highly liquid capital markets where investors can easily buy and sell securities. Other markets may be less developed, with fewer participants and limited transparency. These differences can affect how risk is measured and how capital is priced. Analysts must consider whether global financial data or local market data better reflects the risks faced by the company. Tax systems also vary widely between countries. Different tax rates, incentives, and regulations can influence where companies locate operations and how profits are reported. International companies often structure their operations in ways that manage taxes across multiple jurisdictions. Understanding these structures helps analysts estimate the long-term effective tax rate used in valuation. Cross-border valuation also requires careful attention to capital flows. Cash generated in one country may not always be easily transferred to another due to regulations or currency controls. These restrictions can influence how profits are used and distributed. Another important factor involves economic growth differences across regions. Emerging economies may grow faster than mature economies. Companies with strong exposure to high growth regions may experience greater long-term expansion opportunities. However, higher growth markets may also carry higher risks related to regulation, political stability, and currency volatility. Because of these complexities, analysts must carefully examine the geographic structure of a company's operations. Understanding where revenue is generated and where capital is invested provides valuable insight into risk and growth potential. Despite these challenges, the core principles of valuation remain unchanged. Value is still determined by the future cash flows a company can generate and the risk associated with those cash flows. Cross-border analysis simply adds additional layers of economic and financial considerations. By carefully adjusting for currency, inflation, political risk, and local market conditions, analysts can build valuation models that reflect the global nature of modern business. With this chapter, the discussion of advanced valuation techniques reaches an important milestone. We have explored many of the hidden financial elements that influence company value. The next part of the journey shifts focus from measuring value to actively creating and managing it within organizations. This leads into the next section of the book. Two companies may look identical on the surface. Both may report similar revenue and profit. Both may appear equally efficient. But once you examine taxes, leases, pension obligations, and accounting adjustments, the real economic picture can become very different. This is where advanced valuation techniques become essential. The purpose of this part is not to make valuation more complicated. The purpose is to make it more accurate and closer to economic reality. Investors who ignore these deeper details may still produce numbers, but those numbers may not represent the true value of the business. Small adjustments in taxes, capital structure, or accounting treatment can change valuation outcomes significantly. In the modern world, these complexities are becoming more common. Companies operate across borders. Digital businesses use little physical capital. Accounting choices influence reported performance. Economic conditions, such as inflation, affect long-term forecasts. Understanding these advanced elements allows analysts to see beyond the surface of financial statements. It allows them to separate accounting appearance from economic substance. Once those foundations are clear, this section deepens the analysis. It introduces adjustments that refine valuation and bring it closer to the real economic engine of a company. And the journey into these deeper layers begins with one of the most powerful forces affecting corporate value. Chapter 28. Corporate Portfolio Strategy. A company is rarely just one single business. Most large organizations operate in several industries, products, or markets. Some of these businesses grow quickly. Some produce stable cash flow. Some struggle and consume resources. Because of this reality, leaders must constantly ask an important question. Which businesses should we own and invest in? And which businesses should we leave behind? This is the heart of corporate portfolio strategy. It is the process of deciding how a company allocates its capital across different businesses in order to maximize long-term value. Many companies make the mistake of believing that size automatically creates strength. They expand into many industries simply to grow larger. But growth without discipline can destroy value. A strong portfolio is not defined by how many businesses a company owns. It is defined by how well those businesses create value together. Each business unit should be examined through the same lens. Does it earn returns above the cost of capital? Does it have the ability to grow while maintaining strong returns? Does it strengthen the overall strategy of the company? If the answer to these questions is yes, the business deserves investment and support. If the answer is no, leaders must consider change. Sometimes the right decision is improvement. Management may redesign operations, reduce costs, or strengthen competitive advantage. Sometimes the right decision is divestiture. Selling a business that does not fit the strategy can free capital for better opportunities. Corporate leaders must avoid emotional attachment to businesses. A division may have a long history within the company. It may employ many people. But if it consistently destroys value, holding it only weakens the organization. Another common mistake occurs when companies spread their resources too thin. When capital is divided among too many projects, none of them receives enough support to reach full potential. A focused portfolio allows leaders to concentrate resources where they create the greatest value. Portfolio strategy also requires understanding the role of each business. Some businesses generate steady cash flow. These businesses often operate in mature industries with slower growth. Their purpose is to provide financial stability and fund new investments. Other businesses focus on growth. They may require heavy investment today, but promise strong returns in the future. A healthy corporate portfolio usually contains a balance of these roles. Stable businesses support growth businesses. Growth businesses build the future of the company. However, balance must always be guided by economics rather than tradition. Managers should continuously evaluate whether each business still fits the long-term strategy. Competition also plays an important role in portfolio decisions. If a company does not possess a meaningful advantage in a particular market, it becomes difficult to earn returns above the cost of capital. In such cases, remaining in the business may not be wise. Portfolio strategy therefore involves honest assessment of strengths and weaknesses. Companies must identify where they can truly win and where they cannot. Capital allocation is one of the most powerful responsibilities of senior leadership. Every investment decision shapes the future of the company. Money placed in the wrong business can destroy value for many years. Money placed in the right opportunity can create lasting growth and wealth. Successful companies regularly review their portfolios. They analyze performance. They compare returns with the cost of capital. They examine industry trends and competitive position. These reviews lead to strategic actions such as investing, restructuring, acquiring, or divesting businesses. Another key idea in corporate portfolio strategy is synergy. Some businesses work better together because they share customers, technology, or distribution networks. When synergy exists, the combined value of businesses can be greater than the value of each one individually. But synergy must be real, not imagined. Many companies justify acquisitions by promising synergies that never materialize. Disciplined analysis is essential before making such decisions. Ultimately, the purpose of corporate portfolio strategy is simple. It ensures that the company's capital flows toward its most valuable opportunities. When portfolio strategy is managed well, the organization becomes stronger over time. Resources shift away from weak businesses and towards stronger ones. The company becomes more focused, more competitive, and more valuable. This strategic discipline lays the foundation for the next important topic. Once a company understands where it should compete, it must also understand how to evaluate strategic decisions using data and analysis. That is the focus of the next chapter. Chapter 29. Strategic Management Analytics. Every company creates strategies. Leaders decide which markets to enter. They choose which products to develop. They decide how much to invest and where to compete. But a strategy without careful analysis can become nothing more than a hopeful story. Strategic Management Analytics brings discipline to these decisions. It connects strategy with measurable economic outcomes. Instead of relying only on intuition, leaders use data and structured thinking to guide choices. The goal is simple. Every strategic decision should ultimately improve long-term value. To achieve this, managers must understand the economic drivers of their business. Revenue growth, operating margins, capital investment, and competitive advantage all influence value creation. When leaders evaluate strategy, they must ask a series of clear questions. Will this decision increase long-term cash flow? Will it improve returns on invested capital? Will it strengthen our ability to compete in the future? Strategic analytics helps answer these questions by translating strategic ideas into financial impact. For example, consider a company planning to enter a new market. The idea may appear attractive because the market is growing quickly. But growth alone does not guarantee value creation. Managers must analyze how much investment is required. They must estimate how strong competitors are. They must determine whether the company can achieve returns above the cost of capital. If these conditions are not met, the strategy may destroy value even if revenue increases. Another important use of analytics is identifying the key drivers of performance. Every business has a few variables that influence value more than others. In a retail company, store productivity and inventory turnover may be critical. In a technology company, innovation speed and customer acquisition may be more important. By identifying these drivers, managers can focus attention on what truly matters. Strategic analytics also helps companies understand trade-offs. Every strategic decision involves choices between different paths. Investing heavily in growth may reduce short-term profits. Cutting costs may improve margins but harm innovation. Entering new markets may increase opportunity, but also increase risk. Analytics allows leaders to evaluate these trade-offs in a structured way. Instead of guessing which path is better, they can analyze potential outcomes and compare them. Another powerful tool in strategic management is scenario analysis. The future is uncertain. Markets change. Technology evolves. Customer behavior shifts over time. Scenario analysis prepares companies for different possible futures. Managers explore how strategy performs under different conditions. They consider optimistic scenarios, realistic scenarios, and challenging scenarios. This approach improves resilience because leaders are not surprised when conditions change. Strategic analytics also improves communication inside the organization. When strategies are supported by clear data and reasoning, employees understand the direction of the company more easily. This alignment increases focus and execution quality. However, numbers alone cannot create a good strategy. Analytics supports judgment, but it does not replace leadership. Managers must interpret results carefully and remain aware of uncertainties in forecasts and assumptions. The best organizations combine rigorous analysis with thoughtful leadership. They use data to test ideas, challenge assumptions, and guide decisions. Another benefit of strategic analytics is accountability. When companies measure the expected value of strategic initiatives, they can later evaluate whether those expectations were achieved. This learning process improves future decision-making. Over time, organizations become better at choosing the right opportunities and avoiding costly mistakes. In many companies, poor strategies are not caused by lack of intelligence. They are caused by lack of discipline in analysis. Exciting ideas move forward without careful evaluation. Assumptions remain untested. Risks are underestimated. Strategic management analytics reduces these problems by forcing clarity. It asks leaders to explain how a strategy will actually create value. This discipline helps companies remain focused on their ultimate goal, creating sustainable long-term value for owners and stakeholders. But even the most advanced analytics cannot succeed without the right mindset inside the organization. Culture, incentives, and leadership behavior shape how strategies are executed. The next chapter explores this human dimension of value creation. Chapter 30: Strategic Management, Mindsets, and Behaviors. A company can have excellent analysis, detailed financial models, and sophisticated strategies. Yet many organizations still fail to create value. The reason is often not a lack of intelligence or information. The real reason is mindset and behavior. Strategy is not only about numbers. It is also about how leaders think, how teams make decisions, and how organizations behave over time. In many companies, the culture unintentionally discourages value creation. Managers may focus on short-term performance instead of long-term value. They may protect their own divisions rather than consider what is best for the entire organization. They may avoid difficult decisions because change feels uncomfortable. Strategic management requires a different mindset. Leaders must focus on economic value rather than accounting results alone. They must evaluate every major decision through the lens of long-term value creation. One of the most important behavioral principles is long-term thinking. Markets often reward quarterly performance, But companies that focus only on short-term earnings may sacrifice investments that create future value. Research shows that companies with long-term orientation often outperform others over time. They invest in innovation, talent, and capabilities that strengthen their competitive position. Another essential mindset is disciplined capital allocation. Every investment uses scarce resources. Managers must treat capital as if it belongs personally to them. They must ask whether each project truly earns returns above the cost of capital. This discipline prevents organizations from pursuing projects that look impressive but do not create real economic value. Transparency is also a powerful behavioral factor. When information flows freely inside an organization, leaders can make better decisions. Problems are identified earlier. Opportunities are recognized faster. In contrast, when information is hidden or distorted, poor decisions become more likely. Managers may present overly optimistic forecasts to secure approval for projects. Senior leaders may not receive an accurate picture of business performance. Creating a culture of honesty and openness improves strategic decision-making. Another important behavior is willingness to challenge assumptions. Every strategy is built on expectations about the future. Markets, technologies, and customer preferences can change quickly. Strong organizations encourage constructive debate. Leaders invite different perspectives. They question assumptions and test ideas before committing large investments. This process may feel uncomfortable, but it protects the company from costly mistakes. Incentives also play a major role in shaping behavior. Employees respond to what is measured and rewarded. If managers are rewarded only for revenue growth, they may pursue growth that destroys value. If they are rewarded for accounting profits alone, they may avoid necessary investments. Effective incentive systems align rewards with long-term value creation. Metrics such as return on invested capital and economic profit encourage managers to make better decisions. Leadership example is equally important. Employees observe how senior leaders behave. If leaders consistently focus on value creation and disciplined decision-making, the entire organization begins to adopt the same mindset. However, if leaders chase short-term gains or ignore economic principles, those behaviors quickly spread. Strategic management also requires resilience. Even well-designed strategies face unexpected challenges. Economic conditions change. Competitors respond. Technologies evolve. Organizations must remain flexible and willing to adapt. This adaptability comes from learning, experimentation, and continuous improvement. Another key behavior is collaboration across business units. Large companies often operate through multiple divisions. If each division acts independently without coordination, the company may miss opportunities to create additional value. Shared knowledge, common goals, and cooperation allow organizations to leverage their collective strengths. Ultimately, the purpose of strategic management is to guide the entire organization toward long-term value creation. But achieving this goal requires more than analytical tools. It requires the right mindset embedded in daily decisions. When leaders combine strong analytical frameworks with healthy organizational behaviors, strategy becomes more powerful and effective. Decisions become clearer. Resources are allocated more wisely. The organization moves consistently toward sustainable value creation. These cultural and behavioral foundations also play an important role when companies pursue major strategic actions. One of the most significant actions companies take is combining with other businesses to accelerate growth and create new opportunities. This leads directly to the next chapter. Chapter 31: Mergers and Acquisitions. Few strategic decisions attract as much attention as mergers and acquisitions. Companies often pursue acquisitions to grow faster, enter new markets, gain technology, or strengthen competitive advantage. When successful, mergers can accelerate value creation and transform an organization. However, history shows that many mergers fail to create value. Some destroy enormous amounts of shareholder wealth. Understanding why this happens is essential for disciplined corporate strategy. At its core, an acquisition should follow the same economic logic as any investment decision. The acquiring company must ask a simple question: Will this transaction create more value than the capital required to complete it? In other words, the expected future benefits must exceed the price paid for the acquisition. Many companies forget this basic principle. They become excited by strategic possibilities or competitive pressure. They pursue deals simply because competitors are expanding or because opportunities appear rare. This emotional momentum can push companies to pay too much for acquisitions. Overpaying is one of the most common reasons mergers fail to create value. Even if the target company is strong, paying an excessive price can eliminate any future benefit. Value creation in mergers usually comes from one of several sources. The first source is operational improvement. The acquiring company may manage the target business more efficiently, reduce costs, or improve performance through better management practices. The second source is strategic synergy. Two businesses may create more value together than separately. For example, they may share distribution networks, combine research capabilities, or reach customers more effectively. The third source is growth opportunities. The acquisition may allow the company to enter new markets or expand products faster than it could alone. However, these sources of value must be realistic. Managers sometimes overestimate synergies when planning acquisitions. They assume cost savings or revenue growth that prove difficult to achieve in practice. Disciplined analysis requires carefully estimating the economic benefits of the deal and comparing them with the acquisition price. Integration planning is another critical factor in successful mergers. Even when strategic logic is strong, poor integration can weaken results. Employees from different organizations may have different cultures and operating styles. Systems and processes may not align easily. Customers and partners may react unpredictably to the change. Successful companies plan integration early. They identify leadership responsibilities, communication strategies, and operational changes before the transaction is completed. Clear communication is especially important during mergers. Employees often feel uncertainty about their roles and future. Customers may worry about changes in service or product quality. Transparent communication helps maintain trust and stability during the transition period. Another important principle in mergers and acquisitions is strategic fit. Not every attractive company is a good acquisition target. The target must strengthen the acquiring company's long-term strategy. It should complement existing capabilities or provide advantages that the company cannot easily develop internally. If the acquisition does not fit the overall strategy, it may create complexity without meaningful benefit. Companies must also remain disciplined about capital allocation when evaluating deals. The excitement of large transactions can sometimes distract leaders from other investment opportunities. A company may achieve better results by investing in its existing businesses rather than pursuing expensive acquisitions. Therefore, acquisitions should compete with other investment options for capital. They must demonstrate strong value creation compared with alternative uses of funds. Another important lesson from successful acquirers is consistency. Companies that develop strong acquisition capabilities often treat mergers as part of a broader strategy rather than isolated events. They build experience in evaluating targets, negotiating transactions, and integrating operations. Over time, they improve their ability to create value through acquisitions. In contrast, companies that pursue occasional large acquisitions without consistent strategy often face greater risks. Ultimately, mergers and acquisitions are powerful strategic tools. They can accelerate growth, reshape industries, and strengthen competitive advantage. But they must be approached with discipline, clear strategic logic, and realistic expectations. Without these elements, acquisitions may become expensive mistakes. Understanding when to acquire is only part of portfolio management. Companies must also know when to separate from businesses that no longer fit their strategy or create value. This important decision leads directly to the next chapter. Chapter 32. Divestitures. Corporate strategy is not only about buying businesses, it is also about knowing when to let them go. Many companies focus heavily on acquisitions and expansion. They celebrate growth, new markets, and larger size. But experienced leaders understand an important truth. Sometimes value is created not by adding businesses, but by removing them. This process is known as divestiture. A divestiture occurs when a company sells, spins off, or separates a business unit. The goal is to improve the overall corporate portfolio and strengthen long-term value creation. At first glance, selling part of a company may seem like a sign of weakness. Managers may feel that divesting a business means admitting failure. However, in reality, disciplined divestitures often demonstrate strong strategic leadership. Businesses change over time. Markets evolve. Technologies shift. Competitive advantages that once seemed strong may weaken. A business unit that once fit perfectly within a company's strategy may eventually become less aligned with the organization's future direction. In these situations, continuing to hold the business can limit value creation. One common reason for divestiture is lack of strategic fit. A company may operate a business that does not share customers, technology, or capabilities with its core operations. Managing such a business can distract leadership and consume resources that could be used more effectively elsewhere. By selling that unit, the company can focus more clearly on areas where it has stronger competitive advantages. Another reason for divestiture is poor economic performance. If a business consistently earns returns below the cost of capital, it may destroy value over time. Even if revenue appears strong, weak returns indicate that resources are being used inefficiently. In such cases, selling the business may allow another owner to operate it more effectively while freeing capital for better opportunities. Divestitures can also unlock hidden value. Sometimes a business unit performs well, but remains undervalued inside a larger corporation. Investors may struggle to understand its true performance because it is combined with other operations. Separating the business through a sale or spin-off can reveal its value more clearly. Both the parent company and the new independent entity may benefit from greater strategic focus. Timing also plays an important role in divestitures. Selling a business during strong market conditions may generate higher value for shareholders. Waiting too long can reduce potential returns if performance declines or market demand weakens. Successful companies regularly review their portfolios and identify candidates for divestiture early. This proactive approach allows leaders to make thoughtful decisions rather than reacting under pressure. Communication is another critical factor during divestitures. Employees, customers, and investors must understand the strategic reasons behind the decision. Clear explanations reduce uncertainty and maintain trust. Employees within the divested business may worry about their future. Customers may wonder whether service will change. Investors may question whether the company is shrinking or losing strength. Transparent communication helps address these concerns and reinforce the long-term strategy. There are several ways companies can execute divestitures. One approach is a direct sale to another company or investor. This method often provides immediate cash that can be reinvested in core operations. Another approach is a spin-off. In a spin-off, the business becomes an independent company, and shares are distributed to existing shareholders. This allows both companies to pursue separate strategies while maintaining value for investors. In some cases, companies also create partial sales or joint ventures. These structures allow them to reduce ownership while still maintaining some strategic connection. Regardless of the method, the underlying principle remains the same. Divestitures should strengthen the company's ability to create long-term value. Companies that actively manage their portfolios often outperform those that hold businesses indefinitely. They continuously evaluate where capital is best deployed. They invest in strong opportunities and exit areas where value creation is limited. In this way, divestitures are not signs of retreat. They are tools of strategic focus. A company that knows both when to acquire and when to divest demonstrates disciplined portfolio management. Once businesses within the portfolio are clearly defined, another important question emerges. How should the company finance its operations and return capital to shareholders? This leads to the next chapter. Chapter 33. Capital structure, dividends, and share repurchases. After a company decides where to compete and which businesses to own, another important question arises. How should the company finance its operations and return value to its shareholders? This question leads to the concept of capital structure. Capital structure refers to the mix of debt and equity that a company uses to fund its activities. Equity represents money invested by shareholders. Debt represents money borrowed from lenders that must be repaid with interest. Choosing the right balance between debt and equity is a critical strategic decision. Too little debt may limit financial efficiency because borrowing can sometimes lower the overall cost of capital. But too much debt increases financial risk and can threaten the stability of the company during difficult periods. Therefore, the goal of capital structure management is not simply to minimize debt or maximize borrowing. The goal is to find a balanced structure that supports long-term value creation. Companies must consider several factors when determining their capital structure. The stability of their cash flows is one important factor. Businesses with predictable and steady cash flows may safely carry more debt. In contrast, companies with volatile earnings should maintain more financial flexibility. Industry characteristics also influence capital structure decisions. Some industries traditionally operate with higher debt levels because their revenues are stable and assets can support borrowing. Other industries require lower debt levels due to higher uncertainty or rapid technological change. Another important consideration is financial flexibility. A company must maintain the ability to invest in opportunities when they arise. Excessive debt may limit this flexibility by restricting access to additional financing. Beyond financing operations, companies must also decide how to distribute cash to shareholders. Two common methods are dividends and share repurchases. Dividends are regular payments made directly to shareholders. They provide investors with steady income and signal financial stability. Many mature companies adopt consistent dividend policies because their businesses generate reliable cash flow and require fewer large investments. Share repurchases offer another method of returning capital. When a company buys back its own shares from the market, the total number of shares outstanding decreases. As a result, each remaining share represents a larger ownership stake in the company. Share repurchases can also provide flexibility because companies can adjust them more easily than regular dividend commitments. However, both dividends and repurchases must be evaluated carefully. Returning capital to shareholders is beneficial only when the company does not have better opportunities to invest internally. If a company has strong projects that generate returns above the cost of capital, reinvesting cash into the business may create more value than distributing it. Therefore, capital allocation remains the central principle. Management must continuously compare the value of reinvesting in the business with the value of returning cash to shareholders. Another factor influencing payout decisions is investor expectations. Some investors prefer stable dividends because they rely on predictable income. Others may prefer share repurchases because they increase long-term capital appreciation. Clear communication helps investors understand the company's approach to capital returns. Companies must also consider how capital structure decisions affect valuation. Debt changes the financial risk of the company. Higher financial risk generally increases the expected return required by investors. As a result, changes in capital structure can influence both the cost of capital and the overall value of the business. Disciplined companies evaluate these effects carefully before making major financing decisions. Another key principle is consistency with strategy. Financing decisions should support the long-term goals of the organization. If a company plans to pursue significant acquisitions or investments, maintaining financial flexibility becomes especially important. On the other hand, companies with stable, mature businesses may choose to return a larger portion of their cash flow to shareholders. Successful capital structure management therefore requires balance, discipline, and long-term thinking. It connects financial policy directly to corporate strategy and value creation. However, even the most carefully designed financial strategy must be understood by investors. Markets respond not only to financial performance, but also to the clarity of communication between companies and their shareholders. When investors clearly understand a company's strategy, capital allocation, and long-term goals, they can evaluate the business more accurately. This makes communication with investors a crucial part of managing value. The next chapter explores this important relationship between companies and the investment community. Chapter 34. Investor Communications. Creating value inside a company is only part of the story. The other part is making sure that investors understand that value. Public companies operate in a world where investors constantly evaluate their performance and future potential. Share prices move not only because of results, but also because of expectations. If investors misunderstand a company's strategy, they may undervalue the business even when it performs well. If expectations become unrealistic, the market may overvalue the company temporarily, and then react sharply when results fail to meet those expectations. This is why investor communication plays a crucial role in value management. Investor communication refers to the way companies explain their strategy, performance, and future outlook to shareholders and the broader financial community. Effective communication builds trust and credibility. It allows investors to understand how the company creates value and how management plans to sustain that value in the future. One of the most important principles of investor communication is clarity. Companies should explain their business model, strategy, and financial priorities in simple and consistent terms. Investors need to understand the key drivers of value within the business. These drivers may include revenue growth, margins, capital efficiency, innovation, or market expansion. When management explains these drivers clearly, investors can evaluate the company's performance more accurately. Consistency is another important element. Companies should communicate the same strategic priorities over time unless circumstances truly change. Frequent shifts in messaging may create confusion and reduce investor confidence. Transparency is equally essential. Investors recognize that no company performs perfectly at all times. Challenges and setbacks are part of business reality. When companies communicate openly about both successes and difficulties, they build credibility. Investors often trust companies that acknowledge challenges more than those that only highlight positive results. Investor communication also helps align market expectations with the company's long-term strategy. For example, if a company plans to invest heavily in innovation or expansion, short-term profits may decline temporarily. Without proper communication, investors may interpret these results as poor performance. But if management clearly explains the long-term value of those investments, investors may support the strategy and maintain confidence in the company. Another important aspect of communication involves financial guidance. Many companies provide forecasts or expectations about future performance. These forecasts help investors understand management's outlook. However, they must be used carefully. Overly optimistic guidance can damage credibility if results fail to meet expectations. Conservative and realistic communication builds stronger long-term relationships with investors. Investor communication also involves regular interaction with analysts and institutional investors. Earnings calls, investor presentations, and annual meetings provide opportunities for dialogue between management and shareholders. These interactions allow investors to ask questions and gain deeper insight into the company's strategy. Companies must also ensure that communication remains fair and consistent for all investors. Public disclosure rules exist to prevent selective sharing of information with only a small group of investors. Maintaining equal access to information supports market integrity and investor confidence. Another important goal of investor communication is helping the market understand long-term value drivers rather than focusing only on short-term results. When investors understand how a company plans to create value over many years, they may evaluate the business more patiently and rationally. This long-term perspective benefits both the company and its shareholders. Ultimately, investor communication connects internal strategy with external perception. It ensures that the value a company creates is recognized and understood by the market. Strong communication strengthens credibility, aligns expectations, and supports stable relationships with investors. However, not all companies operate in identical environments. Some operate in emerging markets where economic conditions differ significantly from developed economies. Valuation in these environments requires additional considerations. This brings us to the next part of the book: special situations. Most valuation problems look clean on the surface. You analyze performance, you forecast cash flow, you estimate risk, then you calculate value. But the real world is rarely that simple. Some companies operate in environments where uncertainty is higher. Some grow at extraordinary speed. Some move with economic cycles. Some operate under strict financial structures like banks. In these situations, standard valuation approaches must be adjusted. This part focuses on those special situations. The goal is not to replace the core valuation framework. The goal is to adapt it to real-world complexity. In many cases, the biggest challenge is not calculation. It is understanding the environment in which the company operates. For example, a company in a stable and developed market may have predictable cash flows and lower risk. But a company operating in a rapidly changing economy faces different challenges. Currency movements, political uncertainty, and changing regulations can all affect value. Similarly, high-growth companies may show little profit today. Traditional valuation methods may underestimate their future potential if growth is not analyzed carefully. Cyclical businesses rise and fall with economic conditions. Looking at a single year of performance can give a misleading picture. Banks and financial institutions operate under unique rules. Their balance sheets and risk structures require different valuation approaches. Another important factor in special situations is flexibility. Managers often have the ability to adapt decisions over time. They can delay investments, expand operations, or change strategy as conditions evolve. This flexibility itself has value. Understanding these complexities allows investors and managers to make better decisions. It prevents oversimplification and improves the accuracy of valuation. If you have followed the journey so far, you now understand the foundations, techniques, and strategic aspects of value creation. This final part adds depth by addressing situations where standard assumptions may not fully apply. And the journey into these real-world complexities begins with one of the most dynamic and challenging environments in business. Chapter 35. Emerging Markets. Not all markets behave the same way. Some are stable, predictable, and well-developed. Others are growing rapidly, changing quickly, and filled with uncertainty. Emerging markets fall into the second category. These markets often offer strong growth opportunities. Rising populations, increasing income levels, and expanding industries create the potential for rapid business expansion. For investors and companies, this growth can be attractive, but it also comes with additional risks that must be understood carefully. One of the most important differences in emerging markets is economic volatility. Growth rates can change quickly. Inflation may be unstable. Currency values can rise or fall significantly over short periods. These factors directly affect company performance and valuation. Another key challenge is political and regulatory uncertainty. Government policies may change suddenly. Regulations may evolve as economies develop. Legal systems may not be as predictable as in more established markets. This uncertainty increases risk and influences the cost of capital. Currency risk is also a major factor. Companies operating in emerging markets often generate revenue in local currency. However, investors may evaluate returns in a different currency. If the local currency weakens, the value of future cash flows may decline when converted into the investor's currency. Therefore, valuation must consider expected currency movements and associated risks. Access to reliable information can also be more limited in emerging markets. Financial reporting standards may differ. Data availability may be lower. This makes careful analysis even more important. Investors must use judgment and sometimes rely on broader indicators to understand performance. Despite these challenges, emerging markets can create significant value when approached correctly. Companies that succeed in these markets often build strong local advantages. They understand customer behavior. They adapt products to local needs. They develop efficient distribution networks. These advantages can lead to high growth and strong returns over time. When valuing companies in emerging markets, analysts must adjust their assumptions. The cost of capital is usually higher due to increased risk. Forecasts may include greater uncertainty. Scenario analysis becomes especially important. Instead of relying on a single forecast, analysts consider multiple possible outcomes. They evaluate how value changes under different economic conditions. Another important concept is distinguishing between temporary and structural risk. Some risks may decrease as the market matures. Others may remain for a long time. Understanding this difference helps in building more realistic long-term assumptions. Capital structure decisions may also differ in emerging markets. Access to financing can be more limited or more expensive. Companies may rely more on internal cash flow or alternative funding sources. Investors must consider these constraints when evaluating growth potential. Partnerships and local knowledge are often critical for success. International companies entering emerging markets may benefit from working with local partners who understand the environment. This reduces risk and improves execution. Another key factor is long-term perspective. Short-term volatility can be high in emerging markets. Prices and performance may fluctuate significantly. But over time, strong companies with solid fundamentals can create substantial value. Patience and discipline are essential when investing in these environments. Emerging markets also highlight the importance of flexibility. Companies must adapt to changing conditions quickly. They must respond to shifts in demand, regulation, and competition. Those that remain rigid may struggle to succeed. Ultimately, valuation in emerging markets is about balancing opportunity and risk. The potential for growth is often higher, but so is uncertainty. Successful investors and managers recognize both sides of this equation. They adjust their expectations, apply disciplined analysis, and remain aware of changing conditions. As economies continue to develop, many emerging markets may become major drivers of global growth. Understanding how to value companies in these environments becomes increasingly important. However, emerging markets are only one type of special situation. Another important category involves companies that grow at an exceptional pace, often with uncertain profitability in the early years. This leads to the next chapter. Chapter 36: High Growth Companies. Some companies grow slowly and steadily over time. Their revenue increases at a predictable pace. Their profits are stable. Their future is relatively easy to estimate. But high-growth companies are very different. These companies expand rapidly. They enter new markets. They attract customers quickly. They often prioritize growth over short-term profits. At first glance, they may appear risky or even unprofitable. But many of the most valuable companies in the world once looked like this. Valuing high-growth companies is challenging because the future plays a much larger role than the present. Traditional valuation methods rely heavily on current earnings and stable assumptions. But high-growth companies may have low or negative profits today. Their value comes from what they can become in the future. This requires a shift in thinking. Instead of focusing only on current performance, analysts must evaluate the company's potential to scale. They must ask whether the business model can generate strong returns once the company matures. One of the most important factors in valuing high-growth companies is revenue growth. Rapid growth can create value if it is supported by a strong business model. However, growth alone is not enough. If growth requires excessive investment and does not lead to future profitability, it may destroy value. Therefore, analysts must examine unit economics. They must understand how much it costs to acquire customers and how much value each customer generates over time. If each additional customer contributes positive economic value, growth becomes powerful. If not, growth may simply increase losses. Another important factor is scalability. High-growth companies often operate in industries where costs do not increase at the same rate as revenue. For example, digital platforms and software businesses can serve many additional customers without large increases in cost. This allows margins to improve as the company grows. Scalability is a key driver of long-term value in high-growth businesses. Competitive advantage also plays a critical role. Rapid growth attracts competitors. If a company cannot defend its position, its growth may slow and margins may decline. Strong brands, network effects, technology, and customer loyalty can help protect competitive advantage. When valuing high-growth companies, forecasting becomes more uncertain. Growth rates may change quickly. Market conditions may evolve. New competitors may emerge. Because of this uncertainty, analysts often use multiple scenarios. They consider optimistic outcomes, realistic expectations, and more conservative possibilities. This approach provides a range of potential values rather than a single estimate. Another important concept is the transition from high growth to stable growth. No company can grow rapidly forever. At some point, growth slows as the market becomes saturated. Valuation must reflect this transition. Early years may show high growth and lower profitability. Later years should reflect more stable growth and stronger margins. Estimating when and how this transition occurs is one of the most challenging aspects of valuation. Investment requirements are also critical. High-growth companies often require significant capital to expand operations, develop products, and acquire customers. Analysts must estimate how much investment is needed to support growth and whether future returns justify that investment. Another important factor is management quality. Leadership plays a key role in executing growth strategies. Strong management teams allocate resources wisely, adapt to changing conditions, and build sustainable competitive advantages. Weak management may struggle to convert growth opportunities into lasting value. Market expectations also influence the valuation of high-growth companies. Investors often have high expectations for future performance. If the company meets or exceeds these expectations, value may increase significantly. But if performance falls short, valuations can decline quickly. This makes high-growth companies more sensitive to changes in sentiment and expectations. Therefore, disciplined analysis is essential. Investors must separate realistic potential from overly optimistic assumptions. They must avoid being driven by excitement alone. Despite these challenges, high-growth companies can create substantial value when managed effectively. They can transform industries, introduce new technologies, and generate strong long-term returns. Understanding how to value these companies requires patience, careful analysis, and a long-term perspective. High growth is only one type of special situation. Another important category involves companies whose performance changes with economic cycles. These businesses require a different approach to valuation. This leads to the next chapter. Chapter 37. Cyclical Companies. Not all businesses grow in a steady and predictable way. Some companies rise and fall with the economy. Their performance improves during strong economic periods and declines during slowdowns. These are known as cyclical companies. Examples include industries such as manufacturing, construction, energy, and commodities. Demand in these industries depends heavily on economic activity. When the economy is strong, demand increases. Prices may rise, profits improve quickly. When the economy slows, demand falls. Prices may decline. Profits can drop sharply or even turn into losses. This pattern creates unique challenges for valuation. If an investor looks at a cyclical company during a peak period, the business may appear extremely profitable. Margins are high, earnings are strong, growth looks attractive. But this performance may not be sustainable. Similarly, during a downturn, the same company may appear weak or unprofitable. Earnings decline, margins shrink. The business may look unattractive. However, this weak performance may also be temporary. Therefore, the key challenge in valuing cyclical companies is avoiding decisions based on temporary conditions. Instead of focusing on a single year of performance, analysts must think in terms of a full economic cycle. They must estimate normalized earnings. This means understanding what the company earns on average over both strong and weak periods. Normalized performance provides a more accurate picture of long-term value. Another important factor is pricing behavior. In many cyclical industries, prices change based on supply and demand. When demand is high and supply is limited, prices increase. When supply exceeds demand, prices decline. These price movements have a direct impact on revenue and profitability. Analysts must understand industry dynamics and estimate how prices behave over time. Cost structure is also critical. Some companies have high fixed costs. This means that a large portion of their expenses does not change with production levels. During strong periods, high fixed costs can increase profitability because additional revenue flows directly to profit. But during downturns, these same fixed costs can reduce profitability significantly. Understanding cost structure helps explain why cyclical companies experience large swings in earnings. Another key concept is capacity and investment cycles. In many cyclical industries, companies invest heavily when demand is strong. They build new factories, expand production, and increase capacity. However, if too many companies invest at the same time, supply may exceed demand in the future. This can lead to lower prices and reduced profitability. Therefore, timing plays an important role in cyclical industries. Companies that invest carefully and maintain discipline during boom periods often perform better over the full cycle. Balance sheet strength is also important. Because cyclical companies experience periods of low earnings, they must be able to survive downturns. Companies with strong financial positions can withstand difficult periods and recover when conditions improve. Those with high debt or weak cash flow may struggle during downturns. Valuation of cyclical companies often requires scenario analysis. Analysts consider different economic conditions and estimate how the company performs in each scenario. They evaluate both upside potential during strong periods and downside risk during weak periods. Another important approach is using long-term averages. Instead of relying on recent results, analysts look at historical performance over many years. This helps identify patterns and estimate normalized margins and returns. Market expectations also influence valuation in cyclical industries. Investors often become optimistic during strong periods and pessimistic during downturns. This can create opportunities. During downturns, strong companies may be undervalued because current earnings are low. During peak periods, companies may be overvalued because earnings appear unusually high. Disciplined investors recognize these patterns and avoid being influenced by short-term sentiment. They focus on long-term fundamentals rather than temporary conditions. Cyclical companies require patience and careful analysis. Understanding the full cycle is essential for making sound investment decisions. These businesses can create significant value when managed well and evaluated correctly. However, they also carry risks that must be understood and managed. Cyclical behavior is one type of complexity in valuation. Another important type involves industries that operate under very different financial structures. Banks are a prime example. Their balance sheets, risks, and performance measures differ from most other companies. This leads to the next chapter. Chapter 38. Banks. Banks are very different from most other companies. They do not produce physical products. They do not operate factories. Instead, they manage money. Their business model is based on taking deposits, lending money, and earning the difference between interest received and interest paid. Because of this, traditional valuation methods must be adjusted when analyzing banks. In most companies, analysts separate operating activities from financing activities. But in banks, financing is the core operation. Deposits are not just a source of funding. They are a central part of the business model. This makes standard concepts like free cash flow more difficult to apply directly. Instead, valuation of banks focuses more on balance sheet strength, profitability, and risk management. One of the most important factors in valuing a bank is asset quality. Banks lend money to individuals and businesses. Some borrowers repay their loans, while others may default. If a bank has poor asset quality, it may experience losses that reduce its value. Therefore, analysts carefully examine loan portfolios, credit standards, and default rates. Another key factor is capital adequacy. Banks are required to maintain a certain level of capital to absorb potential losses. This capital acts as a buffer that protects depositors and the financial system. A well-capitalized bank is generally more stable and less risky. In contrast, a bank with insufficient capital may face serious challenges during economic downturns. Profitability is also essential. One common measure is return on equity. This reflects how efficiently the bank uses shareholder capital to generate profits. A bank that consistently earns high returns on equity is often considered strong and well managed. However, high returns must be evaluated carefully. They should come from sustainable operations rather than excessive risk-taking. Risk management is at the core of banking. Banks face various types of risk. Credit risk arises when borrowers fail to repay loans. Market risk comes from changes in interest rates and financial markets. Liquidity risk occurs when a bank cannot meet its short-term obligations. Effective risk management systems are essential for maintaining stability and long-term value. Another important factor is the interest rate environment. Changes in interest rates affect both the income and costs of banks. When interest rates rise or fall, the difference between lending rates and deposit rates may change. This directly influences profitability. Regulation also plays a major role in banking. Banks operate under strict regulatory frameworks designed to ensure stability and protect the financial system. Regulations influence capital requirements, lending practices, and risk management. These rules can limit flexibility, but also reduce systemic risk. When valuing banks, analysts often use different approaches compared with other industries. Instead of focusing heavily on discounted cash flow, they may rely more on metrics such as price-to-book value and return on equity. Book value represents the net value of the bank's assets after liabilities. Because bank assets are closely linked to financial instruments, book value becomes a meaningful reference point. Comparing market value with book value helps assess whether a bank is overvalued or undervalued. Growth in banks also looks different from other companies. Banks grow by increasing loans, deposits, and financial services. But rapid growth can increase risk if lending standards decline. Therefore, sustainable growth is more important than rapid expansion. Management quality is critical in banking. Leaders must balance growth, profitability, and risk carefully. Poor decisions can lead to significant losses and instability. Strong management teams maintain discipline, enforce risk controls, and build long-term trust with customers and regulators. Banks also play a central role in the economy. They support businesses, enable investment, and facilitate financial transactions. Because of this importance, their performance can influence broader economic conditions. Valuing banks requires a deep understanding of their unique structure. It requires focusing on risk, capital, and balance sheet strength rather than only income statements. When analyzed correctly, banks can provide stable returns and long-term value. But they must be evaluated with the right framework and careful attention to risk. Banks represent one of the most specialized cases in valuation. But there is one final concept that applies across many different situations. It is the idea that flexibility itself can create value. Managers are not forced to follow a fixed path. They can adapt decisions as new information becomes available. This leads to the final chapter. Chapter 39. Flexibility. In most valuation models, the future is presented as a fixed path. We estimate revenue. We project costs. We calculate cash flow. We assume that once a plan is set, it will unfold exactly as expected. But real business does not work this way. Managers make decisions over time. They observe results. They learn from new information. They adjust their actions. This ability to adapt is known as flexibility. And flexibility itself has value. Traditional valuation methods often underestimate this value because they treat decisions as fixed. They assume that once an investment is made, the company must continue along the same path regardless of changing conditions. In reality, companies can respond to uncertainty. They can delay projects. They can expand successful initiatives. They can reduce losses by exiting weak opportunities. This dynamic decision-making creates additional value that is not always captured in standard models. One simple example of flexibility is the option to wait. A company may have the opportunity to invest in a new project. Instead of committing immediately, management may choose to wait for more information. If conditions become favorable, the company can proceed. If conditions worsen, it can avoid the investment. This ability to wait reduces risk and can improve overall value. Another example is the option to expand. A company may begin with a small investment in a new market. If the market responds positively, it can increase investment and grow further. If results are disappointing, the company can limit its exposure. This staged approach allows companies to manage uncertainty more effectively. Flexibility also includes the option to abandon. If a project consistently underperforms, management can choose to exit rather than continue investing. This prevents further losses and allows capital to be redirected to better opportunities. These types of decisions are often described as real options. They are similar to financial options because they provide the right, but not the obligation, to take certain actions in the future. Real options thinking encourages managers to view investments not as single decisions, but as a series of choices over time. This perspective is especially valuable in uncertain environments. Industries such as technology, natural resources, and pharmaceuticals often face high uncertainty and changing conditions. In these situations, flexibility can significantly increase value. Another important aspect of flexibility is strategic adaptability. Companies that can quickly adjust their strategies in response to market changes are more likely to succeed over the long term. Rigid organizations may struggle when conditions shift. Flexible organizations can respond, innovate, and capture new opportunities. Valuing flexibility requires careful thinking. It is not always easy to quantify. However, ignoring it can lead to undervaluing businesses that have strong adaptive capabilities. Analysts must consider how management might respond to different scenarios. They must think about possible decisions at each stage of a project. This requires combining financial analysis with strategic judgment. Flexibility is closely linked to uncertainty. The greater the uncertainty, the more valuable flexibility becomes. When the future is predictable, there is less need for adaptation. But when outcomes are uncertain, the ability to adjust decisions becomes a powerful advantage. Another key factor is management quality. Flexibility only creates value if leaders make good decisions. If management fails to recognize opportunities or delays necessary actions, the benefits of flexibility may be lost. Therefore, strong leadership and decision-making are essential for capturing the value of flexibility. Flexibility also connects back to earlier concepts in the book. It relates to capital allocation, strategic management, and risk assessment. Companies that allocate capital wisely often build flexibility into their plans. They avoid committing all resources at once. They preserve options for the future. This approach improves resilience and long-term performance. Ultimately, flexibility reflects a deeper truth about business. The future is uncertain, but it is not uncontrollable. Companies are not passive observers of events. They are active decision makers. By recognizing this, valuation becomes more realistic. It moves beyond static forecasts and begins to reflect the dynamic nature of business strategy. Flexibility completes the journey through special situations. It highlights that value is not only created by current performance or future projections. It is also shaped by the choices companies can make along the way. With this final concept, the understanding of valuation becomes more complete. From foundational principles to advanced techniques and real-world complexities, the goal remains the same: to understand what truly creates value and how it can be sustained over time.